Ever since we were little girls, you've compared us to each other.
On hand. And Dan, did you draft Tom Brady yet?
I'm rooting for him from afar. I feel like the Bucs are now my number 2 team after the Pats. But you know what? I'm looking forward to the Pats being an underdog. I'm okay with that. You know, if we're not the dominant team again, great. It's okay.
All right. Editor-at-Large Dan Roberts, always good to see you.
Thanks, guys.
All right, let's get back to Inez Ferre for another look at the markets. Inez?
And Brian, we're taking a look at a mixed picture right now. We have the Nasdaq, which is in green territory, the S&P and the Dow in the red. Google's Danish unit is saying that tax authorities started a review of Google's accounts in Denmark to see whether the company owes more taxes. Now, Denmark's prime minister is one of several European leaders who want global tech companies to pay more taxes in the companies in which they operate. We're watching Virgin Galactic this morning. This is after it was started as outperform at Cowen with a price target of $22, with the Cowen's analysts saying that Virgin Galactic is uniquely positioned to benefit from the growing consumer interest toward luxury experiences, especially among high net worth individuals. Year to date, the stock is up more than 54%. And then we're also watching Zoom up almost 3%. Investors' expectations are very high for Zoom's quarterly results will come after the close. Zoom year to date is up more than 350%. It has seen major tailwinds because of COVID-19, because of people working from home, using Zoom from home. And the company has guided for revenue anywhere between $495 and $500 million, and adjusted earnings per share anywhere between 44 and 46 cents. Brian?
And Zoom better absolutely blow it out of the water. And not just blow it out of the water a little bit, really blow it out of the water. Thanks so much, Inez. All right, up next for the On the Move crew, they'll speak with Twilio CFO Cosima Shipchandler. The tech stock is up a cool 270% in the last 5 months because of the work from home trade that has also benefited Zoom. And of course, they'll keep an eye on all things market. Do stay tuned. On the Move is coming up next.
Welcome to Yahoo Finance on the Move. I'm Adam Shapiro. It's 11 a.m. on the East Coast. We are 90 minutes into the trading day. Here is where stocks are heading. The S&P 500, it's up basically, well, it's flat, but it's been up about 0.25% at one point. The Dow is negative. It's off about 160 points. NASDAQ is positive by 73 points. Shake up on Wall Street. ExxonMobil out of here. Leaves the Dow after nearly 100 years in the index, replaced by Salesforce. We've got more on who's in and who's out. That's just ahead. The Dow changes come as two big tech names become a lot cheaper, at least for now. We're going to break down Apple and Tesla stock splits for you. And on the fast track, the FDA's commissioner, Dr. Stephen Hahn, says the U.S. could approve a vaccine before the end of phase 3 trials. Welcome to On the Move. I'm Adam Shapiro. Julie Hyman is off this week. Joining us this hour on the panel are Brian Chung and Julia LaRoche. Let's talk about what's happening on the Dow. And we want to bring into the stream Ryan Dietrich. He is LPL Financial's Chief Market Strategist. He's joining us from Charlotte, North Carolina. It's good to have you here. And I guess from an investment standpoint, let's talk about who's in and who's out first on the Dow and what this truly means. I mean, ExxonMobil's out, Chevron is still in, but Salesforce is now in, Amgen is in, Honeywell. What is this telling us?
Yeah, well, right here, guys, I mean, if you look back at history, okay, once you're added the next year, you tend to underperform a little bit. The guys that get kicked out actually do a little bit better. And that's kind of from a psychology point of view. You're probably getting kicked out because you're not doing that great. And you're probably getting added because you're doing pretty good. So that's just something to be aware of. But the thing that gets us, I guess, the most when you talk about, the stock split that Apple's going to have, and then just kind of the makeup of the Dow after these changes, there is less tech now than there was before. And, you look at the Dow, we'll call it flat for the year, give or take. S&P up 8 or 9%. Obviously, NASDAQ up 30%. I mean, if tech continues to be a leader, like we've said, come on, you guys, for a while, so we like technology, we like growth here at LPL Research. If that keeps happening, this change that was just made, it's probably just going to kind of continue. We're going to continue to see that is the honest truth here.
Hey, Ryan, it's Brian Chung here. So obviously the big news today, obviously with the stock splits becoming effective specifically for Tesla and Apple. And I'm wondering, those are two large tech company names that have just benefited amazingly over this rally. But I'm wondering, with the advent of fractional trading, it's not like those stock splits really mean all that much. But because of this might be more of a signal from these healthy companies that, yeah, our stock price can go higher. Is that a trend that you expect to see even more so in the following months, despite the economic uncertainty, that maybe other stocks, other large cap companies might try to do the same?
Yeah, it's kind of follow the leader, right? For years, we didn't have stock splits, and you probably could have. And now we're starting to see them. Also, I think it was like Thursday or Wednesday or Thursday last week was the official 20-year anniversary of when, stock prices were go by the decimal point. They used to be fractions, like you said. So that's kind of a happy anniversary on that one. But I mean, it's really unique when you think about, is it really matter? Does Warren Buffett, who just had his 90th birthday yesterday, as a lot of us have talked about, is he splitting his shares? No. Is there any main reason? Is there any major benefit to it? At LPL Research, we'd say, well, probably not. It's not going to change the fundamentals of this company. But obviously, just this morning, the Wall Street Journal had a good article that showed how the small traders are making up like 25% of the overall volume, by far the most we've seen over the past 10 years at least. So yes, people can trade. Now there's fractional shares, so it is a little easier, but still, I think these companies are wanting in on the action, and the lower stock prices, or by the stock meaning of a stock split, seems like a trend that we're probably going to continue to see here over the coming, we'll call at least next year or two, probably.
Well, part of that trend is fueled by the fact that the Wall Street Journal article today that, individual traders are back in this market, approaching something like 20% of the volume. But I wanted to ask you, Ryan, is that somewhat misleading as to the true value of stocks which are being traded when we see these kinds of volume movements?
Oh, I mean, let me put it this way. I guess, when we had that 10-year bull market, I know it ended, and now we got a new bull market potentially. I heard the whole time up, volume's light, it's a warning sign. I mean, I hate to say this time is different, the four most dangerous words to investing, but honestly, guys, volume is not quite what it used to be. And I don't think that's quite the warning sign, but getting to what it means right now, obviously a lot of the small traders have been involved and done really well, we're up, 60%, last 5 months, and they've picked some of those names that have done well, and they've jumped in there. So that contrarian, you start wondering, could the small traders be getting in here at a major peak? And is this a warning sign? We'd say maybe a near-term peak. I mean, September is the worst month of the year. We're going to hear a lot about that tomorrow. And in the election year, September, October tend to have pullbacks. So maybe if there's a little too much froth here with the individual investors getting excited and some of these stock splits, maybe a well-deserved break after a 60% rally is what the market needs here.
So let's continue that conversation, Ryan. And Do you think that the market has more room to run here as we head into I mean, we're already in the back half of the year, but as we get toward the end of the year, what is sort of your outlook there? And what are some of the things that you think investors should be paying attention to? You mentioned the election being one of them.
Yeah, I mean, clearly the election's going to be forefront, but honestly, if the economy keeps opening up, I mean, look at the data, right? FactSet said like 98% of companies have reported, and 84% of them just beat in the second quarter, and forward guidance was good. The housing data is just unbelievable. So as long as the economy keeps opening up, we still think that this bull market's alive and well. But after the big stretch we've had, the 60% rally, maybe a break makes sense. But looking out into the future, what did the Fed say last week, right? Lower for longer is here to stay. Economy's opening up. We're going to get a fiscal plan eventually, but I'm kind of shocked as everybody else, right? 6 all-time highs in a row, and we still don't have that plan from from Congress, which I think is surprising that the market's doing this well. But I think it's all about the economy, which keeps defying the skeptics and improving.
Ryan Dietrich is LPL Financial Chief Market Strategist. Ryan, I don't know if you can see it. This time is different. The book is on the shelf right above the other book, which is The Subtle Art of Not Giving. I'm not going to say it. All the best to you, buddy. We're going to move on to the Tesla stock split because you can't ignore that. Tesla shares right now are trading higher. They're up almost a little bit over 9%. Want to talk about this with the panel. And let me start with Julia LaRoche. Why would Tesla, I get it. You get a stock split. The stock was on a tear over $2,000 a share. Why would it be up so dramatically today? Julia, have I got you there?
Hey there, Adam. I actually can't give you a definitive answer as to why, other than when you have a split, you just have a lower entry point for more investors. But I honestly just can't tell you why.
You know, I think to jump on Julia's point here, when it comes to Tesla and Apple, it is interesting that both these large tech companies at the same time announced that they would be doing a stock split. I think what's interesting is that in this time and age, and we talked about this with Ryan just now, fractional trading really kind of reduces the need for this type of financial engineering, if you will, right? A lot of people on Robinhood or on even other types of platforms like TD Ameritrade, Schwab or whatever, they can get access to shares even if a Berkshire Hathaway, for example, is at a multi-thousand point level. You can just buy a certain fractional shares, leave it up to the brokerage to figure that out. I think this is really more about messaging. When a company divides its stock up, it's signaling to its investors that we could see this stock going back up in price again. That's why it's usually a trend that stocks that split tend to be multiple types of actions. At Apple, for example, splitting their stock today, this is far from the first time that they've done it. I believe this is the 5th time that they've done it in their company history. So something to be mindful of as we start to see these other types of large companies see their stock prices rise pretty quickly as well.
So let's bring into this discussion Craig Irwin from Roth Capital. He's an analyst at Roth Capital in New Jersey. And I just want to make sure that you unmute there, Craig, so that we can hear what you have to say, because a lot of people love Tesla. Why?
Tesla's just done an amazing job over the last several years, essentially single-handedly creating the category of EVs as a viable commercial product. And there's a real halo around the company and its aggressive adoption of technology. So they're the leaders. They are aggressive and moving much faster than the rest of the automotive industry, and literally years ahead of their next closest competitors.
Hey, Craig, it's Brian Chung here. So a lot of people are looking at these two types of companies that announced their stock splits, Apple and Tesla. Another type of name that you might want to loop in there is Amazon as well, but their stock price around $3,500. Why isn't a company like Amazon going to follow suit? Would you expect companies like that to follow suit? What does that say, I guess, institutionally about the way that maybe their financial teams are approaching the stock prices when they watch their day-to-day changes?
Yeah, Elon is very, very market savvy. And I think the fact that he's one of the early movers and others are following is just something that underscores that he's on the bleeding edge, right? And Tesla's got ambition. He has a pay package that's tied to multiple milestones over the next several years, and I'm quite sure he expects to pull that entire pay package down. So we're just getting pieces of his business strategy to achieve that. And I think there's many more things to come from Tesla over the next several years.
Craig, it's interesting you just brought up that they're years ahead of competitors, yet we continue to see more and more new entrants to the space. Walk us through that. And How long do you think that competitive edge lasts? What is your more long-term thesis here for Tesla?
So I'm actually long-term bearish for Tesla, right? So I think, there's more than 400 EVs that are going to be on the road by the end of 2025. Many of those are redos for tier one OEMs that have done something and not really executed as well as expected. Porsche has a beautiful car with the Taycan, but the performance is just not there. Let's be honest. Um, Many of those cars I expect to be successful. Some of those are from well-established brands or marques like Porsche or BMW or Audi, but many are from other companies that we're seeing fund quite successfully in this market. Names like Canoo and Fisker and Nikola that are not yet household names for a lot of America.
Well, Fisker's been around for a while, but they've had, a lot of starts and stops. But let's get back, with Tesla, it's more than just the car though, right? There's the news about their software update with the autopilot system to detect speed limit signs and also, those traffic cameras that some of us got speeding tickets a couple years ago. Don't want to admit to that too much. But there's more to Tesla than just the car. There's also just the battery technology. Would they ever sell that to other manufacturers?
So I know multiple people that have tried, including people with business relationships with some of the people on the board of directors or still on the board of directors. Even their own companies have been unsuccessful in procuring batteries from Tesla over the last many years. Tesla's using essentially everything that it can produce. I think the battery future is interesting. I don't think they have anything unique that Panasonic or LG or Li Shen doesn't have. I think, where they are differentiated and where investors are probably much more excited is around autonomous. So people spend what, $7,000 plus for FSD in a Model 3 today. There's expectations, Elon tosses out a $100,000 value in the future. That's aggressive, but if people believe, then they end up being wildly bullish on this stock. And I think that's a large part of the institutional participation over the last 6 months.
And Craig, I know that this seems like a million years ago, but if we rewind to the end of last year, it seemed like the biggest story for Tesla from a bear or bullish case was really what their numbers were going to look like in China. As the Chinese economy kind of gets restarted after all of this, I'm wondering, what have you seen on that front that provides either headwinds or tailwinds to their business model over the future?
So China is actually executing very, very well. It looks like the Model 3 will have a proportionately larger opportunity in China than the S and the X. So that will end up being a very important market for them. But one of the things that I pointed out to investors a few months back is India's next. There are plans for a facility in India that are being developed right now. They're in the process of choosing a site for the facility. India, I expect to be announced before the end of the year. That's a market that could be just as big as China and just as exciting as China. And this is one of the things investors are looking for.
All right, Craig Irwin, Roth Capital Analyst, all of that, and still bearish, though, on Tesla long-term. We're going to bring you back at some point on that one. Thank you very much. Let's talk about the FDA, because the director of the FDA has hinted that there may be a fast-track option for a COVID-19 vaccine, even if it hasn't finished phase 3 trials. Anjali Kamlani follows everything COVID and coronavirus for us. Anjali, why, and does it make sense to do that? Other countries are doing it, right?
Other countries are doing it. That's correct. And this has been one of those things that many health experts have been worried about in terms of what the FDA could be doing. We saw last week with the convalescent plasma just how much that concerned the community when it comes to, is the FDA bowing to political pressure, or, does the commissioner truly believe that it is in fact safe and effective it is safe to authorize any vaccine before phase 3 trials are complete? Just a reminder, phase 3 trials are that final stage in testing the durability and effectiveness of a vaccine. And that is something that health experts have said it cannot be rushed because time to observe the results is important. And so this is one of those things that we're really waiting to see what happens. As we saw FDA Commissioner Hahn telling the Financial Times that, in fact, it's up to the companies. And if they do, in fact, apply, it's up to the FDA to determine that. Meanwhile, we've heard from some health experts like Dr. Dr. Howard Foreman at Yale University, saying that it's not that we don't have vaccines, we do. And that's sort of the same statement that we've seen when it comes to Russia and China already having those vaccines being used by their populations. But it's not about whether or not we have them, it's about whether or not they are in fact approved and safe and effective. So that's the main concern right now that we're waiting to see, how it all pans out. There's an October 22nd meeting of outside advisors that many are waiting to hear from.
And Anjali, I know that going into the lockdowns that so many cities and states experienced in the spring, we were all very concerned about ventilators. So there was the effort to produce ventilators, and now word that the Dutch company, Philips, they make ventilators, but we're not going to take, what is it, tens of thousands that the US was going to buy from them?
It's in fact 43,000, and that's a very steep number for ventilators. As we remember, there were concerns about where they were going to be coming from. We saw the push that the Trump administration had for domestic production and what that meant for companies like car makers and others. And so that is definitely a concern right now. We have also seen a reduction in the need for those ventilators. Of course, we know that medical protocol has changed over time. When it comes to proning, such as laying patients on their stomach and other treatments that have been used. So definitely a big hit to Philips, which has said that they are also going to have to adjust for their upcoming quarter.
All right, Anjali Khemlani, we appreciate the update on what's going on with COVID, and we know we're going to be speaking with you again in the next hour. There's other medical news, but right now we want to take a look at some of the stocks on the move. Let's start with General Electric. Those shares down almost 2%. This as JP Morgan Chase, the analyst Stephen Tusa, removed his price target on GE, citing a lack of what he called forward visibility. He reiterated that GE remains at a neutral. In his report, he said, unlike its peers, GE continues to have no official guidance, which in our view, and this is a quote, folks, in our view implies difficulty seeing 3 to 6 months out, while debt maturities and options resets suggest GE does not see normal until 2024. On the other hand, though, let's talk about OOTS, and you can debate with your loved ones whether it's pronounced OOTS or UTS. We're going to say OOTS. Those stocks started trading today up about 9% at this point. And the big news there is that it was part of it came to market after it went into the Collier Creek Holdings SPAC. So shares now trading on the Nasdaq up almost 10% at the opening bell. Go get yourself some chips and take some OOTS to the commercial break. A double plus for Warren Buffett. Not only did he turn 90 on Sunday, but he's worth what? Almost $80 billion. I'm not mad at that. Julia LaRoche, there's also some news with Mr. Buffett's Berkshire Hathaway investing pretty heavily into some Japanese trading firms. What does this mean? And it's not quite what some of us would understand as far as traditional trading, right?
Yeah, well, also a pretty interesting investment from Warren Buffett. At least from my perspective, I think it may be the first in Japan snapping up investment stakes in 5 Japanese trading companies. Let me just walk you through the news that came out from Warren Buffett. Berkshire Hathaway's wholly owned subsidiary, National Indemnity Corporation, announced that it has slightly more than 5% of shares in 5 of these Japanese trading companies. They are listed as Itochu, Marubeni, Mitsubishi, Mitsu, and Sumitomo. Just to kind of give you an overview of what some of these companies invest in. Itochi, for example, they have lines of businesses in metals and minerals, food, machinery, engineering, general products, and realty. Others have stakes in media companies, those sorts of things. They kind of remind me of conglomerates, if you will. And Berkshire said that they've been purchasing the shares over the last 12 months through the Tokyo Stock Exchange. And they also noted, I thought this was really interesting, Berkshire said that it has a long history of substantial passive holdings in successful businesses, pointing to Coca-Cola, for example, American Express, Moody's, and that they said that they intend to hold these Japanese investments for the long term. Berkshire also did note that it may increase its holdings up to 9.9% in the 5 investments, but didn't indicate that they would go. Actually, I think Buffett pledged that he wouldn't go above 9.9%. He would keep it at that level. Now, Warren Buffett said in a release, I am, quote, delighted to have Berkshire Hathaway participate in the future of Japan and the 5 companies we have chosen for investment. The 5 major trading companies have many joint ventures throughout the world and are likely to have some of these partnerships. I hope that in the future there may be opportunities for mutual benefit. Based on the closing share prices on Friday, it equates to more than $6 billion, the investment stakes here. I think it's interesting, Adam, to dissect why Buffett would make this move. I don't have a specific answer. He did talk about Japan and why he wasn't investing in companies in Japan at a talk back in 1998. They have all these Buffett archives talking about how they haven't been as, I guess, shareholder responsive in recent years. But of course, when I kind of think about it, I've noticed a lot of activist investors in recent years investing in Japanese companies. I think they have become more shareholder friendly here. And Buffett's certainly signaling it's a long-term play here, also noting that they won't go above that 9.9% threshold on the investment. So definitely an interesting move for the 90-year-old who's clearly able to change his mind.
Yeah, we saw that with the airline stocks, but I want to ask you a question, and you hit upon it when you talked about activist investors, because this is a long-term play for Berkshire Hathaway. But wouldn't it, an activist investor might be doing something like this to gain access maybe to order flow and to maybe get a read on what's happening in specific sectors. Does Berkshire operate that way? Is that even something that would come into play with them?
Wait, can you unpack that question again? I'm not really sure I understand it.
Will they get inside information on where trends are going by being invested in these companies?
I don't think so. I think if I think of Berkshire broadly, though, just kind of stepping back, when I think of the company broadly, I think they have a really incredible pulse on, if you just think about it, the U.S. economy just from their different lines of businesses. So maybe this could give them a read. I would not go as far to say inside information by any means. But I mean, of course, if you have different stakes,
not inside information,
read as to what's going on in the world, you're certainly paying attention. But
well, and no one pays attention better than Berkshire Hathaway. Let's move on to airlines, because we're all going to be paying attention to that. And there was the news yesterday afternoon that United Airlines is going where no airline has gone for a couple of years. They have permanently eliminated their change fees for domestic flights. Could cost you up to $200 if you had bought a ticket and then you wanted to change it. That's out the window, no change fee. And they're also starting January of next year, you'll be able to go standby for free. You won't, that's on domestic, by the way, you won't have to pay a fee. Brian Chung, will we see the other airlines do this? Because like American is saying they will evaluate the options ahead of them.
Well, first of all, the remarkable thing about this announcement is that United does say it's permanent. Of course, color me skeptical. Anything permanent in the airline industry might only be covering a period of 5 to 10 years. But it is pretty remarkable that United is trying to win customers over by getting rid of these fees that have been basically industry standard over the last 10 years. If you ever tried to change your ticket, you know how difficult it is from a technical standpoint just to reach a human being on the phone. But then, secondly, the pain that it puts on your wallet with these change fees. So United's saying that they'll be waiving that or won't be requiring those types of fees for most fares. I do want to note that if you're paying for a basic economy fare on United, you will still have to pay a change fee if you do want to switch flights, in addition to any sort of differences in the fare itself. So let's not necessarily say that this is a blanket. No one's ever going to pay a change fee ever again. But it is kind of interesting to see that as we get out of this rut that the airlines have faced during this COVID-19 crisis, they're trying to use things like getting rid of these fees to bring in new customers, even if that means lower margins.
Okay, Delta has not followed suit on the change fee situation, but they have extended their middle seat, and they did this 2 weeks ago, that they will not fill a middle seat until at least January of 2021, maybe even longer. I mean, airlines cannot make money by getting rid of the change fees or by not filling those middle seats. Is Delta making a mistake not filling the middle seat?
Well, I think you underscore exactly what the problem is there, is that there's a real trade-off between the revenue and then the safety implications of putting people and packing these airplanes and those middle seats. But this is where we've seen the divergence in the airline industry. So you have the likes of Delta, for example, changing their policies here. American Airlines, on the other hand, though, in addition to United, have said that they will start to put people in those middle seats. Then you have airlines kind of straddling the middle with Southwest saying it's almost going to be a best faith effort to try not to put people in there. Although if they need to accommodate last minute passengers, they will put people in those middle seats. So a lot of differences in kind of how the airlines are approaching this policy. I think that as we start to get through the end of this year, where airlines originally may have hoped that they could safely put passengers back on if the virus were contained nationwide, I think they're starting to see this might not be the case. Hence why you have a lot of these airlines extending their policies and saying, you know what, we're not going to put people in those middle seats. But as you mentioned, Adam, for those airlines that decide to do that, that is putting immense pressure on an airline industry that is already feeling the pain and having to rely on government support, as we've talked about at length on these programs.
Okay, Brian, we were just talking about the middle seat. Let's talk about putting you in the driver's seat, or in this case, the pilot seat, since we're talking about airlines. Working from home, we've got the hot stock and the CFO from Twilio, which is powering the ability for all of us to do what we now do, which is work from home. And welcome back to Yahoo Finance on the Move. Looking at shares of Twilio right now, they're off about 0.5%, but they've been on a tear the last 52 weeks. The range has gone from $68 a share to almost $289 a share. Part of the reason is they're powering all of us and the ability to do what we need to do to earn a living. So let's bring in the CFO from Twilio, and that would be Cosima Shipchandler. He's joining us from San Francisco. Good to have you here.
My pleasure. Thanks for having me.
So a lot of us may not be familiar with your company, and in your literature, you talk about powering billions of connections. I think the stat is 500 calls a second, 100 million messages a day. How would I, as a consumer of different kinds of tech, might interact with you, with Twilio?
Yeah, the way to think about it is that we're really a customer engagement company, and the way that we think about that is that we power our customers' ability to engage with their consumers. And so every time that you take an Uber, for example, you interact with some sort of a message, or every time that you get a DoorDash delivery, you interact with some sort of a message. And that could be SMS, that could be inside the app. And it's those kinds of messages that go back and forth between consumers and our customers that we're behind that ultimately enable you to do business with us.
It's been really interesting during this pandemic because you've seen this acceleration of digital transformation. If you look at your Q2 results, revenue up 46% year over year, really tremendous growth. So I want to ask you, how has COVID-19 positively impacted your business, but also negatively impacted your business? Walk us through where you're seeing opportunities and where things are maybe slowing down.
Yeah, I would say by and large, we've been on this road for a long time. And so I would characterize COVID-19 as a mild accelerant. To be sure, there were some down industries that have impacted us. I would put into that category things like rideshare, hospitality, lifestyle industries like that. But on the flip side, we've seen very resilient use cases that have emerged in areas like healthcare, like education, like e-commerce. Even in philanthropy, we've seen some interesting use cases. And I think the net of all that is that there's this emerging secular tailwind around digital transformation that we're now fortunate to be able to enable the power.
Hey, it's Brian Chung here. Now, what's been interesting to me is that, aside from COVID, it does seem like the trend of talking to people online has been something interesting to watch. A lot of people many years ago were saying, I would always prefer to have someone on the phone that I can talk to live. But it seems to me that I've actually come around maybe recently over the last year or two in using some of these live chat features. I find it's actually more effective than trying to wait on the phone for somebody. So when it comes to these types of chat features, like you mentioned in ride sharing apps and other types of applications, where do you feel like the general public is on the learning curve to taking on these types of virtual interactions as opposed to the traditional, interactions over the phone?
I mean, we are really confident about it. I mean, if you just think about the real estate on your phone is very precious. And every time that you get a message or an email even, you're very highly to look at it. And so what we see through the lens of our consumers is that, through our customers and their consumers, is that these message interactions are actually a very, very high ROI. And the indication of that for us is that we're a usage-based pricing model. And so every single day that we wake up in the morning, we've got to fight for new business with our customers. And the fact that they continue to spend money with us, they grow their use cases. In fact, what they're starting to do is grow into new and different use cases. I think that's kind of the proof in the pudding that whether it's SMS or WhatsApp or voice or now even video, all of these channels are extremely relevant for consumers to interact with the companies that they care about.
So you were named by one outlet as a top growth pick in 2020, and they expect that to continue into 2021. I was curious if you want to go it alone, or would you be open to perhaps joining forces to become even larger or more powerful, for lack of a better word?
Well, I think we like what we see in front of us right now. If you're kind of alluding to whether we would look at different M&A opportunities, I think that's definitely an open option. We did a follow-on recently, and a lot of that was certainly geared towards enlarging our balance sheet, having a cash balance that was commensurate with our market cap, and wanting to be opportunistic if assets come along in the marketplace. We're certainly open to partnering with other companies as well. We think there are a number of interesting ways that we can do that to further our aim. And so those are really the areas that we're concentrated on. But for the most part, I mean, we have so much open field running in front of us. I think there's such an enormous opportunity, such a huge tailwind that we're really, really excited about what we can do with our customers and their consumers.
And we wish you the best, Cosima. Chip Chandler is Twilio's CFO. All the best to you and the team in San Francisco. As we head to break, want to let you know everybody's working for the weekend, especially the weekend, which cleaned up at the VMAs. We'll have more from MTV's Video Music Awards after this. News on the move. Police in Portland, Oregon have yet to release details of the shooting that killed a Trump supporter with ties to the far-right group Patriot Prayer. Video shows Trump supporters on pickup trucks clashing with protesters who have demonstrated daily for the last 3 months. The police chief warns not to jump to conclusions about how the victim was killed. President Trump plans to go to Kenosha, Wisconsin Tuesday to show his support for police, despite Governor Tony Evers asking Trump to delay the trip and not inflame the situation. More than 1,200 students and staff have tested positive at the University of Alabama's Tuscaloosa campus in less than 2 weeks since classes resumed there. The Atlanta Journal-Constitution and the Daily Beast reported an email sent from the university's administration to teachers warned professors not to tell students when someone tested positive for COVID-19. Not even a pandemic can stop the annual MTV Music Video Awards. Lady Gaga walked away with several awards, including Artist of the Year. The Weeknd took home Video of the Year. K-pop sensation BTS won awards for Best K-pop, Best Pop, Best Group, and Best Choreography. The outdoor award show proved those of us old enough to remember the slogan, "I want my MTV," get what we want, even if we have to look up what the K in K-pop stands for. Let's turn our attention to news that has been getting headlines all summer long, and that's the potential sale of TikTok. Akiko Fujita joins us now because just yesterday we learned that maybe China could slow down this process. What is this about?
Yeah, Adam, we got that development over the weekend, and we're talking specifically about what's called a restricted export list. This is a list that specifies technologies that cannot be exported without a government-approved license. Now, China, for the first time in 12 years, expanded that list to include 23 additional technologies. Among those on the list are artificial intelligence and data processing technology, which is really at the heart of TikTok's algorithm and the success of its app all around the world, including here in the US. So what does this all mean for this acquisition we've been talking about? Well, the restriction requires Chinese firms to essentially apply for a permit before entering negotiations to transfer the technology. And then it requires a company to actually get a license to export that license once an agreement is in place. The Commerce Ministry over in China says that that could take about 45 days for government approval. So that would put it right up against that deadline in November the Trump administration has set aside to say essentially TikTok needs to be sold, its US operations need to be sold in order to avoid some kind of ban. Now, ByteDance's general counsel has said the company is studying the new regulations and will follow the applicable laws. If the regulation sounds familiar, Adam, it's because the Commerce Department here in the US has had similar restrictions in place for American tech companies that are selling to Huawei. Remember, we talked about this. We've talked about this for months now. Essentially, these companies have to have a license in order to sell anything to Huawei. So if you're looking at it from the Chinese side, you could certainly argue this is a form of retaliation. The US would say this is the Chinese government trying to have some kind of say in where TikTok eventually goes, which company actually is able to acquire it. Bottom line, though, if you are a Microsoft, Walmart, or an Oracle, the question is going to become, can you operate this app with the same technology in the same way post-acquisition? And that's still a question we simply don't have an answer to right now, as both sides push up against this deadline to put in their bid.
And I realize this question is kind of like throwing darts at a dartboard, but the players who might actually wind up acquiring TikTok, there's not much movement or change there. I mean, it's still the big names we've heard: Oracle, Microsoft, Walmart, right?
Microsoft and Walmart in that partnership, and then Oracle, these are the two names that have been mentioned for some time. CNBC, we should point out, is reporting that a deal is imminent, that in fact TikTok has actually decided which partner or which company they would like to sell to. It's worth noting, though, all three of those stocks down in the session today, potentially or likely on the back of that news coming out of China, because now there are certainly questions about what exactly any kind of transfer would look like, or in fact, if the Chinese government would allow for that transfer to happen.
Okay, Akiko, we're going to head into break, but just want to let you know, in the middle of the winter, when you get that notification that your kid's school, and I'm talking about when everyone's back in class, it's a snow day. Well, we've got the CEO from the company that makes that possible for more than 50% of the school systems across the country. And welcome back to Yahoo Finance on the Move. We're watching the markets right now. Dow and S&P are in negative territory. The Nasdaq is still positive. Many, many years ago, some of us made our living on morning local TV news, telling people it was a bad weather day or snow day, so the kids got the day off from school. Then along came the company Entrado. Well, now they do that on the cell phone, so it puts a lot of us out of work who are in local TV. But it's good news if you happen to be the CEO of Entrado. John Schlonsky joins us now because this emergency messaging service, I mean, explain to us what you actually do, because it's what 55% of the schools across the United States and Canada use your school messenger service.
So Adam, thanks so much for having me on the show. It's a privilege to be on it. Intrado really at its root is a cloud-based technology company that connects people with information, and we believe that insight allows individuals to make the best decisions possible. And so, when we talk about School Messenger, we do support 55% of the U.S. and Canada school districts. It's about 63,000 schools, and we're delivering over 3 billion messages a year. And so we not only do it for the education vertical, but we do it for healthcare. We do appointment notifications as well as prescription fulfillment, and include the utility providers as well, allowing them to communicate with their clients and whether power is going to be restored. So the verticals that we support, we're pretty proud of, and our technology is scalable and secure, and we're glad to do it.
Hey, John, it's Brian Chung here. It sounds like you've laid out a few of these applications for your technology. It sounds like a lot of them are for emergency situations, last minute things that people need to know about in their communities. Obviously, right now we find ourselves in the midst of a health pandemic. When it comes to the demand side for your business, are there certain types of applications that you found Entrado technology being used for within the context of the pandemic? And how has that kind of affected, I guess, your business model from a revenue side even?
Sure. Let me unpack that a little bit. First and foremost, we're really proud of the platform and its capability. Like I said earlier, it's a cloud-based solution that delivers secure and scalable information. And so the interesting thing when you think about our solution, it used to be a way for parents just to connect to school when the student was on campus, right? Now we've become a notification provider of COVID-19 learning scheduling changes, virus outbreaks. We provide checklists to faculty about making sure that they're following safety protocols and that they're verified. I mean, nothing's more important than our children. For those of you who have kids, it's what you worry about every day when you wake up. So for us, this platform is really kind of taken on a different lifeline with parents and the community and making sure students and faculty are safe. As it relates to the second part of your question, in terms of the revenue component, we're excited about our growth. And we feel really good about where we're heading, and we have clear line of sight to what other solutions we need to develop. But I have to tell you, we are not going to be one of those companies that charge on a per message basis. We're a SaaS-based model where education communities to sign up for a subscription-based solution. That's a self-service model. It's easy to use. They can customize their own messages, decide who the constituent is that they want to distribute it to, whether it's a cell phone, PC, an SMS message, and really allows them. I don't want a school worried about cost when it comes to the safety of our children and how to keep a community safe. And so Brian, that SaaS-based model really allows them to do the right thing and not worry about cost.
Hi, John. It's Julia LaRoche. I was just looking on your website too, and looking at the various app designs, the website designs, and of course, as you were just talking about, the need state for information during the COVID-19 pandemic. To tie on to Brian's question, how are you, or I guess, what are you kind of hearing from your existing client base as to what more is needed, and how are you kind of thinking of evolving your own business to maybe even debut new product offerings? What are kind of the most important things that schools need now?
It's exactly what you would expect. They need help. I mean, school administrators, parents, students. This digital transformation of remote learning has thrown a curveball and complexities into everyone's life. And so, our job to make sure that we're delivering a single version of the truth to both the faculty and the parents, so they know exactly what's going on, so they can respond to it, is never more critical. We actually just introduced last summer another product. I mean, when we talk about the education and school messenger platform, people think it's educational content. It's actually not. It's an information and safety crisis management solution system. And so our Safety Shield product integrated in with School Messenger really has some unique capabilities that differentiates us from some of our competitors. and allows for schools to manage not only a safe environment, but directly integrate, leveraging one of our other services, which is safety services, where we route most of the 911 calls in America. It allows us to leverage that platform and integrate any kind of emergency that a school may be facing instantly with the public safety and first responder network.
So as you go forward, what does your future look like? Do you become a public company once again? Do you look for partnerships that would take you, in that direction?
Yeah, look, I think for us, people who don't know, we're owned by Apollo Private Equity, and we're one of their few portfolio companies in their portfolio. And so this was a public company at one point. Our goal is to really build the best company that we can. I think historically, I've been here 2.5 years, integrating some of the products to really create synergies and dynamics that really kind of bring to light, and dealing with some of the issues that folks are facing right now in this pandemic is first and foremost on our mind. And making sure that we're doing that in an effective way and in a secure way is our first priority. In doing that, we think we have clear line of sight to growth and opportunities, and can expand this product beyond just education. We're doing it for enterprises as well. And so we're excited about what the future holds, and we'll see what happens when it's time and this market kind of shifts, and whether or not it's something that we'll consider an IPO or not.
Okay. John Schlonsky is Intrado CEO and president. We're going to be back after this with a check on markets.
Thank you very much for having me. It's a pleasure.
And welcome back to Yahoo Finance on the Move. Jared Blickery is keeping an eye on what's happening with markets. And what can you tell us, Jared?
Well, the Dow is underwater, being dragged down by energy and industrials, but the Nasdaq 100 is popping here. And if we take a look at the Nasdaq 100 heat map, a couple of standouts. Apple up over 3.5% after its stock split to a record high. Tesla up 9% after its stock split to a record high, 482 and change right now. Amazon also another record high, along with the discretionary sector. It is up 2% today. And just looking at some of the other names at the leaderboard top, we've got Alexion Pharmaceuticals, Zoom Video, which is reporting its earnings after the close, BioMarin, and Insight. To the downside, we got some chip names. Lam Research is down about 3.5%. Let's take a look at the month's price action. As this is the last day of August, we can see the Dow is going to close up probably more than 6%. We got Nasdaq up over 7%, nearly 8%, including today's gains. And then the S&P 500 up about 6.4%. Well, It's time for the Yahoo Finance Premium investment ideas of the day. And guess what? It's Apple and Tesla, and it's based on those stock splits. So Argus Research is writing about Apple today. As of this morning, they're reflecting a 4-for-1 stock split. For holders as of record, as of last Friday, the split was made, in the words of CEO Tim Cook, to make the stock more accessible to a broader base of investors. Argus is also saying about Apple, a stock split sends a message that management and the board are confident in the company's prospects. They also broaden the base of actual and potential investors. Their price target is now $150, and that is adjusted for the split price. It'd be somewhere up there. And on Tesla, it is now $566. That represents a potential 28% upside. Adam?
Hey, Jared, real quick, when we talk about the S&P 500 having a really strong rally, best performance in more than 30 years, put that into context for a lot of us who want to look forward and not backward.
Well, this is the best August for the S&P 500 since 1986. Now, on average, September is a month with some hiccups. It's the worst performing month since the 1950s. But anytime we have this kind of performance up until this point in the year, we tend to end the year up. So despite election volatility, which is almost a given right now and is getting priced in, more likely than not, we're going to hold on to some nice gains for the year. But a lot of this does depend on what happens with the COVID vaccine and treatment. And of course, there are a lot of unknowns here, Adam.
And we should remember that some of the finest people in the country were born in September, but we'll talk about that in a couple of weeks. Jared, thank you very much. We have more Yahoo Finance on the move for you. We're going to talk about some of the ins and outs of who's in the Dow 30 when we continue in the 12 noon hour. It's Monday, August 31st, 12 noon here in New York City, and we are 2.5 hours into the trading session. As we take a look at where stocks are at this moment, I want to tell you that the S&P 500 is barely down. It's off almost 4 points. Dow is off more than 200 points. NASDAQ is up, but off its session highs. NASDAQ is up roughly 60 points. Coming up this hour, who's in and who's out? ExxonMobil, Pfizer, and Raytheon leave the Dow, paving the way for several big names to join the index. Splitting up the bullseye, both Tesla and Apple, as the big names get a lot cheaper as of today. Also, no help why President Trump's approval rating actually is falling, and it is failing to get a boost from the Republican National Convention last week. Welcome to On the Move. I'm Adam Shapiro. Julie Hyman is off this week. Joining us this hour, On the panel will be Rick Newman and Dan Howley. But right now, we want to talk about what's going on with these markets, and to help us understand the stock splits, which took place after the close on Friday and then went into effect this morning, we invite into the stream Brian Nick. He's Nuveen's chief investment strategist, joining us from New York, New York. So let's talk about this. I mean, when you get for instance, Tesla was $2,000 if you were trading on Friday. Today, you can get it for somewhere between $400 and $500 a share. Should I consider that a bargain if I'm an investor? And how long do I have to wait for the next split?
No, because when the stock splits, not only are you getting it for a quarter or a third or a tenth of the price, you're also getting that fraction of the earnings as well. So it's messing with the Dow Jones Industrial Average level today. So we should probably take whatever the Dow does today with a bit of a grain of salt. But these companies have the same outlook for shareholders per share that they've always had. So thinking about stock splits that way, I think doesn't change our outlook on the individual companies or on the overall opportunity and buying the Dow, buying the S&P.
Hey Brian, Rick Newman here. Is the Dow now going to be a little less reflective of the tech economy since Apple is splitting? Salesforce is a new addition that is in the tech space, but a couple others are really not in the tech space. So will it diverge from, let's say, from the NASDAQ more than usual?
Yes, it will also diverge from the S&P 500, which has by far the largest share in technology of any sector. And the Dow is not representative of the U.S. equity market. You've seen that not just in 2020, but year after year, the performance when technology is the leading sector, which it has been far more often than not, the Dow underperforms the S&P 500. So, with a relatively small number of companies and sort of the arcane weighting system that goes by share price, when things like splits happen or new entrants come in, old companies move out, that's going to tend to mess with that index more than for a better diversified index like the S&P 500, which is why we look at the S&P as our benchmark.
So, Brian, we're looking at something then where we saw Apple go from, the heaviest weighted or rather the most influential now dropping down. I guess overall for the Dow, what does this mean, for someone who wants to invest in specifically a fund that favors the Dow?
Well, most investment funds are not going to benchmark to the Dow, but if you're investing in the Dow, you're getting a less accurate picture of the overall equity market. You're not getting as many technology companies. You're not going to be as high a weight in some of the growthier parts of the healthcare sector. Numbers 3, 4, 5, and 6 in the S&P 500 by weight are not in the Dow. That includes Google, Amazon, Facebook. So when you think about what's really been driving the market, that's not necessarily the entire economy, although this year the two have gone more hand in hand as we've gone kind of to online purchases and more of an online economy. You're not getting a representative sample of what the largest firms are, the money that they're earning for their shareholders, and the growth that they represent in terms of the potential over time.
Hey, Brian, you mentioned that you use the S&P as your benchmark. I'm curious, though, you also talk about the differences that are going on in different sectors of the economy, with obviously leisure, hospitality taking a huge hit. We're going to get the job numbers on Friday. And is this going to skew the S&P 500 or going forward? Is this going to skew in a way that would drive you to avoid some of these down stocks today, but in the long term may recover?
Yeah, the jobs report we think is going to be okay. That reflects the month of August. I think a lot of the pullback that you could see in consumer spending, certainly we're going to see a pullback in income for August because of the lack of renewed fiscal stimulus. That may only start to translate into hiring decisions in September. But without a question, you've seen hiring slow down. You've seen layoffs continue to the tune of about 1 million a week. There are people joining the labor force, but there are people leaving the labor force as well. What that means for the larger companies is you're seeing a lot of downsizing, companies trying to get leaner and meaner, knowing that the markets are paying attention to the bottom line, which includes not only revenues, but lower costs. And this is typical of what you see coming out of a recession. The economy bottoms, GDP bottoms, starts to climb, but the labor force tends to bottom afterwards and only recovers a couple of months or even quarters afterwards. And I think that's what you're seeing. It's different than the initial spring months where we had small businesses that are not publicly listed laying off workers because they couldn't physically open. I think that's a different circumstance that we saw in the spring. A lot of those workers, though not all of them, have come back. What you're going to see for the larger companies is, I think, a desire to increase average worker productivity in the closing months of the year.
Hey, Brian, one more on the Dow. It is still formally known as the Dow Jones Industrial Average. That actually seems a little bit outdated. If you have a suggestion for a better name, I'd love to hear it. But
absent that, do you know the committee at S&P Dow Jones Indices that determines the composition of the Dow? Are they bound by their own rules to in terms of what they can add or take out of the Dow, or do they have broad discretion to change it any way they feel like?
I don't know if they're bound by their own rules in terms of the rules that set in place. To me, the one that makes it the most questionable as a benchmark for the overall market is that the companies are weighted by their share price. So you see a split or just the inclusion of a new company that happens to have a much higher share price can really change how the weights are maintained. One of the things that's really given the S&P 500 the most momentum and by far the best performance of these indexes in the last couple of years has been it's weighted more towards companies with larger market caps, and those companies have continued to grow the most. So when you have the higher growth companies in the sort of the top 5 or 10 names in the index, it tends to result in the index continuing to perform well. And this hasn't just happened relative to the Dow, relative to a lot of active managers who employ more of an equal weight strategy or have a smaller number of companies that they're looking at in terms of their portfolio size. The S&P's managed to outperform a lot of those as well, because unless you were continuing to invest at high weights in very large companies, you had a hard time beating the S&P 500.
Brian Nick is Nuveen's chief investment strategist. Good to see you again, and we wish you all the best. I want to turn our attention to the tech stock splits, which had everyone talking not only on Friday, but right now. To help us break that down, Bob O'Donnell, Technalysis President and Chief Analyst, joins us now. And just refresh us here. When we talk about dilution, a stock split is far different than a company issuing new stock, very simply because the proportion of who owns what doesn't really change when you get a stock split. Is that one of the reasons we might see, say, Tesla going up today?
Well, I think that, and there's just this general excitement, and frankly, the lack of recognition by a lot of people, unfortunately, that in fact, as we were just discussing, it's not like you get any more of the company just because you're getting a single share. You're getting, 1/5 or 1/4 in the case of Apple, what you were previously getting. But look, all of this is psychological, right? Let's not forget that that's really the element that's going on. You've got a lot of people who have been interested in potentially buying into these companies, Apple and Tesla in particular. And so this gives people, who are not necessarily sitting on a whole bunch of cash, the opportunity to get into something and feel like they're making a bigger investment. So really, it's completely a psychological advantage. Frankly, if you look back historically, and I'm sure you guys have talked about this as well, a lot of times after the split, there's a small bump, and then it actually goes down for a bit before it really comes back to where it was. So, but again, I think it's really the psychological aspect, and given how odd the market's been in general lately, I think we can't discount the impact that something like that's going to have.
Bob, does this mean that we're going to actually see new investors flood into the likes of Apple and Tesla? Is that something that is basically predetermined at this point?
I think we will. I mean, if you take a look at, the phenomenon of Robinhood and other places where you've got lots of younger investors getting into these different companies, I think something like this does make that kind of a difference. And I think that's where some of that spike will come. Again, realistically, can it last? It doesn't seem like that's particularly likely, but I do believe, and I think that's why, you hear people like Tim Cook talking about wanting the fact that they want more people to be able to get into the company. So absolutely, Dan, I think that's exactly what they're trying to do, is to get additional people, participating in owning a portion of the company.
Hey, Bob, just to follow up on that a little bit, that's not connected to the fundamentals of the company. That's you're sort of creating demand with a bit of a gimmick in a way. Is that a problem? Does that, if this is sort of like side demand, unrelated to the fundamentals, does that tend to evaporate over time, or can this actually be a lasting? Can it actually get incorporated into the fundamentals of the company somehow?
I don't see how it does. I mean, at the end of the day, as you guys were just discussing, again, the outlook for these companies has not changed just because they've had a stock split. There's absolutely zero change in that regard. But there are more people who are watching it. There are more people perhaps who are involved, more people who have a vested interest. Could that theoretically influence things like elections to board of directors? Possibly that could change things, but realistically, I don't think it does. It's really, again, it's just this sense overall of the fact that there are some people who now feel that they can own a piece of this company that they've watched and make it part of their portfolio. Or frankly, it just gives them an excuse, to be honest with you, is like, oh, yeah, maybe I should consider making an investment there. Couldn't really do it before. Now I can. Doesn't change, again, the fundamental capabilities of these companies, the fundamental outlook of these companies as well.
Bob,
Which, by the way,
I want to ask about when we'll eventually see these companies, if we will eventually see these companies hit those highs again, right? We've split a good amount. We've cut off from the highs that we were seeing. When do you think, or do you think they will eventually reach those really lofty heights?
It's hard to say. And on the Tesla side of the world, I mean, it's not logical. I'm not going to try and pretend to know what's going on over there because really it's so out of sync with reality. If you look at Apple, right, there's a couple of things coming up. We've got the iPhone 5 launch is happening in a couple of weeks, likely. They're going to unveil what people have been expecting them to do for a long time on the services side, which is a bundle to get all their services, because that's a growing piece of their business. So, I mean, we look at some of the basic fundamentals around what these companies are trying to do, particularly Apple, I think there are some interesting opportunities. Same time, if we look at the smartphone market overall, for example, we just saw numbers that last quarter, worldwide smartphone sales were down 20%, and there's a lot more focus these days on PCs. Now, luckily for Apple, they've got some exciting new Macs coming up. They're moving to a different chip architecture inside the Mac. So, I mean, if we look at the fundamentals of what these companies are doing, I do think there's some interesting things on the Apple side. There's some challenges, however, that we can't ignore as well. On the Tesla side, the momentum is there. People are very excited about, obviously what they've been doing, but I just don't know, long term if they're going to be able to sustain that.
Bob, I got to ask you, because the argument you've just made could be applied to, say, like an Amazon, which right now the shares are up over 2%. And when you get a stock split like we've seen with Apple and with Tesla, could that drive momentum to an expensive stock like Amazon, $3,470 and change a share? People speculating, okay, they've got to come next, and it's driving the price up artificially?
It could. It seems to be a general philosophical principle that a lot of the leadership these different organizations have. Some people care about having a stock price that a more average person perhaps could afford, and some people don't seem to care in the least. So it's really hard to say. You could make that argument, Adam. I don't know if it's something that's really going to play itself out. I just think there's this sort of philosophical, psychological mindset with a lot of consumers and consumer investors that changes. It's not going to change institutional investors and the big investors. They know what's going on. But I think it's a different story when we're talking about sort of the smaller investors out on the fringe, so to speak, in terms of smaller in terms of size. That's all I meant by that.
All right. Bob O'Donnell is Technalysis, President and Chief Analyst. Good to have you back here on The Move. Want to turn our attention to what's happening with the election right now. And to help us understand the latest polls, Rick Newman is joining us. I'm trying to follow my outline here in Slack, and it's all moving a little too fast.
I got your back, Adam.
I appreciate that. I won't shap you. No need to interrupt you. But look, we got the latest favorability polls, and it seems to me like when you slice and dice these things, it's like, well, on a Tuesday with a full moon, this candidate does better than on a Wednesday with half moon.
I think you're totally right. There was so in one poll, Trump's approval rating dipped a little bit following the conventions. There was another poll by Morning Consult that showed that Trump gained a little bit on Joe Biden. Let's call it a wash. So I think we can safely say at this point that the conventions probably didn't have any meaningful impact on the horse race between these two candidates. And that's different from the past. I mean, normally one candidate or the other would get a little bit of an edge from the conventions. But, a lot of political analysts going into the convention said, don't expect a bounce. What's unusual about the election climate these days and in 2020 is people are just more polarized. More voters have already made up their minds. There are fewer people left to persuade. So that is where we stand now that we're in the home stretch. For people wondering, maybe 5 to 8% of voters still haven't made up their minds yet. And that's what the battle is going to be over during the next 8 or 9 weeks.
Rick, do these polls give us any sense of what the issue is for those people? Because in just a second, we're going to be checking in with Angelique Kamlani on the latest COVID news. And is COVID going to be the deciding factor, or is it something else?
I don't think we know yet, but we actually did our own poll along with Harris right before the Democratic convention. And there were a couple takeaways from that. First is compared with 2016, voters are more concerned about many issues. So their level of concern and their level of anxiousness or intensity is just a lot higher. And it's not surprising. Look what's going on right now. We have a health crisis, unlike 2016. We have a recession, unlike 2016. And now we have law and order issues and a lot of urban violence related to protests and looting. So all three of those issues, when in that Yahoo Finance Harris poll, we asked voters, what's your degree of concern about these things? All of them scored in the mid to high 80s. That's very high. And back in 2016, there was no single issue on which voters, more than 80% of voters said it was a concern for them. So voters have a lot on their minds as they decide who their candidate is this year.
And the one thing we should point out is some breaking news that as far as in the cases of positive tests for coronavirus in the United States, we have now topped 6 million cases. Turning our attention to something that will happen later today, we want to talk about Zoom. So many of us do Zooms, whether it's for business or for personal reasons. And Dan Halley is going to tell us what we can expect. Will they hit it out of the ballpark once again? Dan?
Yeah, that seems to be what analysts are predicting for this coming quarter, just like they did the last quarter, or rather that Zoom will perform that well as they did last quarter. A lot of this obviously has to do with the fact that Zoom is kind of an ongoing pandemic play and will continue to be. It really got the boost from the fact that people were stuck inside, weren't able to see each other. That resulted in businesses leaning into Zoom as well as schools. And then people personally started using Zoom on their own. Now, the people that are going to be spending money on Zoom are the businesses and school districts, with schools opening again, some doing the 50-50 split, some doing more remote, some doing full remote. You can expect Zoom to see a benefit from that again this time around. So I think what really analysts are going to be looking at is what we expect in the coming quarters, the expectations going forward, what Zoom can provide as far as guidance is going to be very important, because it'll let us know if they're seeing a fallback or they're seeing increased retention of users as a result of the unfortunate ongoing coronavirus pandemic.
Howdy! Hey man, what is the competition for Zoom looking like these days? I know Microsoft Teams was supposed to become a muscular competitor. Are they getting a lot of new competition, or are they holding steady in the lead?
Yeah, they're definitely holding steady. I mean, look, Microsoft's Teams is growing. We have Facebook, obviously, in the video game, video space game, not video games. And then we have, Slack with its own video integration. But it really does seem like Zoom managed to catch kind of the same boost as other single name internet entities that have just taken off, right? You say you're going to Zoom someone now, right? It's become a thing that people do for things like baby showers or even birthdays, right? So I think that it's going to continue to be a big element of people's lives. And I think that is the reason why the stock is going to continue to do well. You're not seeing that from the competition.
Just remember, people used to say, I want a Xerox of something, and we know what happened there. But I got to ask you, from all of the different, potentials for video conferencing out there, whether it's our parent company owns Blue Jeans, whether it's Google Meet, whether it's Zoom, what do the reviewers say about the best option for a business person and then for the personal experience?
I think it really comes down to what the businesses need, right? Because if you have something like Google, Google has its whole GDoc suite. And that gives you something like Google Meets, which we're using now, as well as the ability to use Google Docs, have the online storage that you may need, everything along those lines. So it really comes down to individual need for businesses. And look, when something like Zoom reports, they're reporting on the large businesses that provide the 100,000 plus subscriptions, right? 100,000 in terms of cash that are paid for those. So I think that's really something that's important to point out and look at who is actually paying for these services. Because remember, you can use Zoom for free to a degree, but when you start adding more and more people to a Zoom chat, that's when you start adding the need to start paying.
All right. We're going to move to break, but I want to check stocks on the move right now. And first, let's check out McDonald's. Shares are trading up, or at least they were up 0.25% at the opening bell. The 52-week range between $124 and $221. Now, the big news here is that McDonald's has responded to former CEO Steve Easterbrook's request to dismiss the company's lawsuit against him. Remember, they're trying to claw back the $41 million+ severance package he got. Mickey D's issued a statement saying when McDonald's investigated Steve Easterbrook, he lied. He violated the company's policies, disrespected its values, and abused the trust of his coworkers, the board, our franchisees, and our shareholders. Now, the company spokesperson also said on Monday, called the argument that Easterbrook is making morally bankrupt. Let's also take a look at AT&T. The Wall Street Journal is reporting that there could be a deal trying to be put together for AT&T to sell a large stake, 50% plus, of its DirecTV. The telecom and media giant apparently is working with Goldman Sachs Group to identify who might be a potential acquirer of this. And apparently one of the potential bidders, according to the Journal, would be Apollo Global Management. There could also be a spinoff. They've looked at this in the past, link it up with Dish Network, although there are problems with that as far as antitrust issues. Look, AT&T paid $49 billion for DirecTV in 2015. Today, it's valued at about $20 billion. We'll have more right after this. Welcome back to Yahoo Finance on the Move. I want to talk about a $2.6 billion deal in the works. This involves Nestle and a company that makes a treatment for people who live with peanut allergies. What can you tell us about this and why Nestle would be interested in this?
Thanks, Adam. So what we've learned is that Nestle has actually already had a stake in this company. I believe the total is somewhere in the ballpark of $473 million. That's about a 25.6% equity ownership. And Nestle has already been interested in this company right before the company went for the FDA approval for this therapy. It basically is a powder that introduces peanut allergens into the body. And that's something that experts have said for quite some time is actually important for parents to do for young kids to actually stop the development of peanut allergy. So while many patients have already done this sort of in their own way with peanut flour or other sort of treatments, just sort of at home, this has been the first time that something dosed has been introduced to the market. And so that's the significance of this product, is that it gives some sort of structure to the amount of allergens being introduced.
So, Anjali, is this something really, I mean, are we seeing more peanut allergies? It seems as though, when we were younger, it wasn't as prevalent, or maybe it just wasn't as understood as being dangerous as it really is.
Right. Without the actual data, it's hard to know. But yes, that's definitely been the reason why, like, the American Pediatrics Association has said that even babies, infants should be introduced to peanut allergens really early on to prevent this kind of allergy. So that, I guess, kind of indicates that, it is possible to prevent this, or at least reduce the amount that peanuts affect an individual. Meanwhile, we know that there's just this growing industry, on the food side. You've seen so many places pop up that are, able to create foods just for this sect of society. So very interesting to see, whether or not this does in fact lower the rates. We'll definitely wait to see that.
Angelique Kamlani, we will be watching that, but something else we're probably going to be watching, especially if you live in a part of the country where you can go to a movie, is the movie Tenet. Dan Roberts joins us now to explain why the death of the movie theater may be overstated. Is that accurate?
That's accurate, Adam. I completely agree. And just anecdotally, I just saw a movie at the theater myself here in Connecticut. The state has done a nice enough job with recovery that a lot of theaters are open for in-theater viewing, distanced. My wife and I were the only people in the row. People wore masks. We felt perfectly safe. We did not see Tenet, not out yet in the US, but it's coming this coming weekend. And in its debut overseas, it brought in $53 million, which is pretty good. In fact, it compares to the overseas opening for Interstellar and the one for Dunkirk. Of course, we're talking about Christopher Nolan, the thriller director here. And Tenet is coming Labor Day weekend, I should say, to theaters where theaters are open. Now, unfortunately, that means no New York and no LA, and those are two huge markets. But it's going to be playing at some theaters here for me in my home state of Connecticut, and I imagine that people who are comfortable will go see it.
Well, I'm glad you talked about the fact you wore the mask during the movie and how they spaced everyone out. I got to believe New York State, even other parts of the country where, as you said, theaters are so big, are going to be looking to places like Connecticut. I mean, look, New Jersey is going to be open in restaurant dining. So you got to do that in New York eventually. So do we know anything about the sharing of information on that?
Well, I think it's going to be a huge litmus test to see how the movie fares at theaters that are open. I mean, does it sell out? And sell out, of course, hard to do an apples to apples comparison, but at theaters where they've allowed a certain capacity, do they sell through all the seats that they're going to allow, all the tickets they're going to sell? I'm sure that data will be widely reported and speculated on. And by the way, I think parts of New York State might have theaters, but New York City and LA not having them open is a major problem. Now, let's also mention Tenet, opened overseas first, which was a surprise. It's done well there in the first week. And there's also high expectations for China. Things are safe enough in China that theaters have really bounced back there. In fact, there's already been some movies that have opened in China. So I think Tenet is going to do big, big numbers in China where theaters there are open. And of course, it's a study in contrast because Tenet paired with Mulan, those were going to be the two big first blockbuster theatrical releases. And of course, Disney went a very different direction from Warner Brothers. We know that Mulan is about to hit Disney Plus for a $30 fee. And that's only if you already subscribe to Disney Plus. So we're going to see a lot of comparisons of that. And if Tenet does okay in its limited US opening, you might see people second guessing Disney and saying they should have put out Mulan in theaters where theaters were open.
Dan, I got to ask, we're looking at theaters opening slowly. You got to check one out. I guess, how long do you think it'll take until theaters really see kind of a full return to normalcy, unless that just doesn't happen when we have a vaccine? And anecdotally, how did you feel going into the theater? Because that's something that, personally, I am a little nervous to do.
Yeah, I mean, that's the biggest question. How comfortable will people be? And I don't think there's going to be a hard date where it's like, okay, open up everything. Everyone's good now. Even once there's a vaccine, we don't think, and I'm sure Anjali can answer this better than I, but we don't think that even once there is a vaccine, it'll be instantly widely available, right? So the same question applies to sports. I mean, the NFL says it's starting its season September 10. Some teams have come out and said, we're not going to have any fans. Some teams have said, we're going to have a limited number of fans in our stadium. Well, will fans feel comfortable going with a mask on? Personally, and I should mention what movie we saw. We saw The Personal History of David Copperfield. And that was a Disney movie. It's, of course, from the Dickens book. I thought the movie was great. And we felt very comfortable. I mean, there were 15 people in the whole theater and we wore masks. We got snacks. All the people working in the movie theater wore masks. There was hand sanitizer widely available. We felt fine. It didn't feel to me that different from outdoor dining, if you're distanced, but everyone has a different level of comfort. So I don't think movie theaters are dead. I think they'll bounce back, but it's going to vary state by state, right? And I'm lucky enough that in certain East Coast states like Connecticut, and I think Adam said New Jersey, things are good enough that a lot of businesses are reopening. But of course, in other states, Florida, Texas, Arizona, it's going to take longer.
You mentioned the movie you saw. I'm a year behind. I just saw The Irishman, by the way. Saw it on Netflix. Loved it. Loved the cars in it. But I want to talk about Mulan. There's some confusion. You mentioned Mulan and the fact that I think it's $30. You get to watch it at Disney. But there's confusion as to what that means because you're not downloading it, right?
That's right, Adam. You're not downloading it, although it does get added to your Disney Plus library. And that might be a distinction that has been lost among the headlines. I think a lot of people see the headline and say, $30 to rent it. That's ridiculous. But Trolls World Tour, which you remember was a huge hit much earlier in the pandemic, that was $20 just to rent and watch it one time. This is $30, but you can watch it over and over and over. It gets added to your Disney Plus library. Now, of course, you already have to be a Disney Plus subscriber. So arguably, it's more than $30. But when you consider that you can rewatch it, I don't think it seems as crazy anymore. It doesn't seem like such a ripoff because families with kids who want to watch it, they're going to see that as very worthwhile. I mean, you spend more than $30 going to the movies to see a movie once with a family. Now, for this, you're going to pay $30. You can watch it over and over. There's also a little bit of wrinkle here, a little bit of fine print that the website Screen Rant discovered. They found a Disney press release that mentioned that the movie is going to become free for Disney Plus subscribers for all of them, no extra fee, in December. Now, Disney has hastily scrubbed that date from its documents, of course, because Disney wants the option later on to charge for longer if it's a big hit. But clearly, originally, Disney's plan was, we'll charge $30 unless you want to wait till December, and then it'll just become free for all Disney Plus subscribers.
Hey guys, two thoughts on reopenings. I went to my gym for the first time in 5 or 6 months over the weekend, and I thought, man, it'll probably be mobbed. Everyone's probably dying to get back. And there were 3 people in the whole gym. Dan, you said you went to a movie theater with 15 people. I think if you want to get back to some of these things, now is the time, because a lot of people are actually not going back there. They want to wait and see. So I think you're most likely to find relatively empty theaters now rather than in a few months. But my other question really is, how long can these businesses hold out with, at what, like 10% capacity? I mean, I'm worried about my gym. I look at other businesses, federal aid is going to run out. So we may not have all these movie theaters around once they actually can fully reopen.
Well, you're totally right. And here in New Canaan, Connecticut, we love our local indie movie theater. It's not a chain. It's a one-off, and it's been closed during the pandemic. And I worry about it because even before the pandemic, we would go see movies there, and it wasn't always packed. Now, let's also look at the big chains. AMC, if you remember, like 3 months ago, was in danger of filing for bankruptcy and had to take a immediate kind of bridge loan, take on more debt to survive a while longer. So I think certain chains are in trouble. I don't think that means they go out of business, but I think they might close stores. It's a lot like brick and mortar retail. A lot of these movie theater chains just overbuilt, and they'll close a lot of locations. But you're certainly right. I mean, there's so few people right now that I felt perfectly safe. A while back, we did a road trip. We stayed in a hotel one night, and some people were horrified. You went to a hotel? I felt perfectly safe. We barely saw anyone else in the hotel, and we know how extremely carefully they're sanitizing everything right now. But yeah, I worry about small businesses and how long they can hold out here.
And Dan Roberts gets the last word on that. And we're going to take a break. We're going to check markets when we come back here on The Move. And welcome back to Yahoo Finance on the Move. Let's check markets right now. And we're watching the S&P 500 is off about 2 points. Dow is down more than 200 points. NASDAQ is back up. It is up more than 70 points. Getting back to normal. We want to invite into the stream right now Harris Trifon, Western Asset Mortgage Capital CIO, also co-head of Mortgage and Consumer Credit. He is here to talk with us about the future of the hotel and hospitality industry. And one of the things you point out is that, in your view, there are parallels between what's going to happen in the future of not only the hotel space, but the office space. What are those parallels? And in the hospitality space, what are they learning from offices that are already opening up?
Yeah, thank you for having me on the show today. And absolutely, there are parallels in terms of the impact that COVID-19 has had on both of these sectors. Specifically, and maybe first and foremost, the existential questions that have come up over the result of COVID-19 and the impact that it's had, specifically in the case of office. Are people going to work from home over a permanent basis? How is the flexibility in terms of going to an office versus working from home? How sustainable or not is that? And how does that relate to different markets and different industries? And in the case of hospitality, the impact has been very severe and quite unprecedented. The only parallels we have historically to the impact of this crisis is the aftermath of the September 11th terrorist attacks and the 2008-2009 Great Financial Crisis. The impact that we've seen in hospitality in terms of revenue, in terms of the decline in occupancy, really across the value chain in the country, there really are no parallels. Even those two historical events we could use as guides, but of course, the impact here has been much more severe and has also occurred much more quickly than anything we've seen in the past. So I think to some extent, the parallel with the office is, when are people going to feel comfortable going back to hotels? When are things like corporate travel, when are conferences and events going to come back to the industry? And those are all large questions that are unknown right now.
Harris, what do you think we're going to see as far as, hotels recovery versus something like an Airbnb, right? I mean, I think in my mind, and personally, I've used Airbnb rather than go to a hotel recently, just because it seemed like it was an easier option because there's fewer people around. Do you think that that's going to be an impact going forward for hotels as we start to see more people venture out?
I think absolutely. Although I think I would argue that the impact in terms of the relative value, if you will, between hotels and Airbnb is probably more of a short-term phenomenon than a longer-term phenomenon. We are generally optimistic about the ultimate recovery in the hospitality sector, although clearly cognizant of the unprecedented nature of the sell-off that we've seen and the decline in performance. So I think in terms of a recovery period, it's probably something that's going to take years. Our best guess right now is somewhere on the order of 3 to 5 years in order to see a full recovery in the sector. And so, yes, in the short term, I think there's a lot of individuals who are looking to get out of their houses. They've been trapped for the better part of half a year at this point, who are really focused on Airbnb. I think as restrictions continue to ease, as the economy continues to recover, I think we'll see some of those people begin to gravitate back to more traditional hotels. And then sort of the other factor at play, of course, I mentioned before is, when does corporate travel return? When do conferences and large-scale events return? Of course, they're only able to occur at hotels and not at Airbnb kind of outlets.
And I heard your time frame of 3 to 5 years as part of this question. But when you look at $300 million of hotel properties sold across the U.S. in the second quarter of 2020, going forward, places like New York, places like San Francisco, if you're going to invest, say, in a real estate investment trust, all of those deals are getting redone as, the big hotels might be leasing the space. What's going to be the investment return? Is now a good time for an investor to might look at properties or those kinds of investments in places like New York, San Francisco, the large cities?
We think so. I mean, clearly, as I said before, there's a lot of big question marks in terms of the fundamental outlook for the sector, in terms of how that's going to manifest itself in terms of the different markets, including the two that you mentioned. But there's that uncertainty also leads to investment opportunity. A lot of the deals that were struck, a lot of the mortgages that were struck during the last few years, have experienced a lot of distress as a result of the stress on the broader industry. In securitized products, for example, there's somewhere on the order of $20 billion of hotel loans that are delinquent right now. Many of the borrowers for those loans have requested forbearance or other types of modifications. In our experience, some of those requests have been denied. Some of those requests are in the process of being negotiated between lenders and investors such as ourselves and some of the servicer community. So, there's still some open-ended questions on that front. But, certainly the longer-term outlook, we have a more constructive view on, and some of the uncertainty is leading to outsized risk premiums in the market, which we're looking to take advantage of. In terms of your question about San Francisco and New York, I think those are two good places to start as you think about uncovering the recovery in the sector, and their dynamics in those markets, and really for many markets, are going to be very different. New York, for example, was an oversupplied market coming into the COVID crisis. A lot of construction activity running at multiples of what we had seen historically or what exists nationwide. Certainly, there are going to be many properties that just simply don't reopen. We think another potential outcome of the COVID crisis could be repurposing of hotels, specifically in places like New York, where we potentially envision some of those hotels getting converted into housing, condos, things of that nature. So, there's going to be a process of creative destruction, so to speak, that occurs specifically in places like New York, Las Vegas, Orlando is another market where we're concerned about a glut of supply. Places like San Francisco, we think the recovery should happen sooner rather than later, at least relative to the other three markets that I mentioned.
Harris, Rick Newman here. Let me just ask you to go a bit further on creative destruction. I mean, what are you expecting in terms of hotel closures? And are there any chains that might even declare bankruptcy?
Yeah, I'm a little reluctant to talk about change specifically, but certainly the impact has been severe as we've talked about. I think what's been interesting over the last couple of months as the economy has slowly begun to reopen has been the recovery that we've seen. It's been uneven. Specifically, we've seen much stronger recovery and a bounce back in the lower parts of the value chain, things like economy, limited service, extended stay type of hospitalities, say as compared to urban properties or destination style resort properties. So I think, we're going to see much more stress on the upper end of the value chain than we will on the lower portions of the chain. That is going to lead to, some properties closing. That is going to potentially put pressure on some chains and some flags. That remains to be seen. But I think most of the damage in terms of what's going to be observable in the recovery cycle here is going to be more at a market level for some of the factors that we talked about a few moments ago.
Harris Triffin is Western Asset Mortgage Capital CIO, co-head of mortgage and consumer credit. We appreciate your being here on The Move. We're going to take a commercial break, and we'll be right back with another market check. Welcome back to On the Move. Dow's off by about 230 points. S&P 500 is also in negative territory. Nasdaq is in positive territory. Want to get word on the street right now, and we're going to start with Rick, and a term we all learned back when John Kerry was running for president, and that term swift boat. Why is that relevant now?
Well, a group of people who ran the so-called Swift Boaters for Truth campaign against John Kerry when he ran for president in 2004 now say they're starting a new super PAC to help Donald Trump beat Joe Biden. For people who don't remember, the Swift Boaters were some people who said they served with John Kerry in Vietnam, and they really kind of slammed his service over there and smeared some of his career claims, and that hurt Kerry. He really didn't quite know how to respond to that. It was exceedingly negative, and I think that what that tells us for 2020 is we're going to start to see and hear about some very negative ads targeting Joe Biden. I think we all knew this was coming. This campaign has been pretty ugly so far. It's probably going to get uglier. And when you hear about a super PAC linked to some of these people from GOP campaigns of the past, that tells us. The question is, how will Joe Biden respond? Is he going to fight back from the outset, or is he going to try to take the high road? What happened to Kerry is these ads actually did do a fairly good job of defining him negatively among some voters in 2004. So I'm sure the Biden campaign has that in mind.
Okay, let's turn our attention also to Tesla, because Dan Howley is following another additional rollout of software that people might like. Dan?
Yeah, this is basically a new feature that is able to detect the speed limit by looking at speed limit signs and then provide drivers with an alert telling them if they've exceeded the speed limit that's posted. You'll get a readout of the speed limit as well on your kind of dashboard there in the Tesla. And it'll also provide you with a chime if you're sitting at a green light rather than rolling forward. This is from Electrek, by the way, who's reporting it. And it's interesting because it's another addition to what Tesla has to offer as far as the self-driving features go. But again, this is not full self-driving. You know, as much as Elon Musk likes to say that, in reality, these are all driver assistant technologies that allow you to feel safer while you're driving, help give you an idea of whether or not you're doing something wrong while behind the wheel. This is not full self-driving. Full self-driving, where you see a car literally, leave the driveway of your home and then drive itself to work while you, watch Netflix or pass out. That's not going to be here for some time now. So it is an interesting addition to Tesla, but it's not nearly close to the full self-driving that people have been expecting for years.
Hey, Dan, this news, my reaction is, so what? Tesla does have probably the best electrification technology on the market. It does not have the best self-driving technology on the market necessarily. Why does this even matter?
I think it just helps prove that the vehicles are able to see things like that. They are able to react to actual road conditions, but there are other self-driving technologies that can do that as well. As you said, there are other vehicle manufacturers. GM has their own that does, self-driving, where this driver-assisted self-driving very well. I think for Tesla, it's more showing its customers that it's continuing to provide these iterative updates to the self-driving, autopilot feature that they have. But I think as you probably feel as well as others, it's not fair to really call this self-driving in and of itself. In fact, it's dangerous to do so.
All right, we're going to take a break and be right back after this. All right, welcome back to Yahoo Finance on the Move. We want to talk about college sports and specifically this effort to maybe save what can be saved of some of the college sports football season, in fact, all sports. To help us understand where we stand right now, Pete Thamel, Yahoo sports reporter, is joining us. And when last we looked at this, the Big Ten had essentially canceled the 2020 sports season. I mean, is that accurate the way they said it? Because there's this push to maybe do some things a little bit later or some things a little bit earlier, right?
Well, Adam, the decision they made nearly 3 weeks ago was to postpone the 2020 season. So they'd canceled the fall portion of it and were going to attempt to play in either the winter or spring. And what started as spring ended up moving to January in the plan/hope of some of the coaches. And what was revealed on Friday was that there were discussions, and there's a lot of difference between coach discussions and presidential decisions. But there were discussions that perhaps the league could start playing as early as Thanksgiving weekend.
Dan, I think you wanted in on this.
Yeah, Peter, you look at how these sports have reacted, right? I'm a Mets fan, unfortunately, but Major League Baseball hasn't done particularly well with dealing with coronavirus. And you look at a sport for college, you look at the NFL, for instance. How do they manage to even keep their players safe? I mean, a field is a field, right? You can bubble the NBA because there's different courts that you can put into different conference areas in hotels, but you can't do that with something like football or baseball. What are we just going to see huge outbreaks?
It's a good question, Daniel. I think that's something that the college administrators wake up every morning worried about. I would counter you on Major League Baseball a bit. It has been ugly, but I think the baseline for sports being played this year is that the games are actually played. I really think that's the bottom line when you go ahead and look at whether sports are successful or not. The quality and caliber of college football that we're going to see this year, and really the NFL we're going to see this year, is not going to be the quality and caliber of football we're used to. And when we look ahead to the football seasons that are upcoming, I do think in the college space, to answer your questions, there are going to be outbreaks. There have already been 3 games delayed. There's going to be more. Austin Peay played Central Arkansas on Saturday. Austin Peay's long snapper was in quarantine. So they sailed the ball 40 yards past the punter twice because that's the kind of personnel things that are going to have to happen. Now, where the colleges have to make these decisions, Dan, is how is the health and safety of the players really being impacted? And institutionally and presidentially, I think institutions have had more stomach for outbreaks, more stomach for delays than I thought they would. If you had asked me 2 months ago, I would have thought the first notion of sort of like a Miami Marlins season would have really made administrators queasy. But I think having seen what Major League Baseball went through, college administrators have been more inclined to kind of go for it.
Hey, Pete, we've got about 2 minutes left. And this morning we learned something that none of us expected, but that basketball coach John Thompson passed away. His family told us this. He was 78 years old. I was at Syracuse, by the way, in the mid-'80s, back when the big rivalry with Georgetown. What more can you tell us about the impact he had on not only college sports, but sports in general?
Yeah, well, Adam, I really think when you look at the legacy of John Thompson, it's one of the most profound legacies in the history of college basketball. You're talking about someone who was just an instrumental figure in so many different fundamental building blocks of the sport as we know it. You mentioned Syracuse. I went to Syracuse too. John Thompson was the first Big East coach to win a national title, and he was just instrumental in that growing into the big monster brand it was in the 80s, 90s, and beyond. John Thompson was the first African-American coach to win a national title. And he's been an inspiration to generations of African-American coaches since then. He really turned Georgetown into a cultural touchstone in the 1980s. The starter jacket, the sneakers. Georgetown was like a vibe. It was a living, breathing, teeming thing. The intensity, the way they played, the style, the pressing on the court. John Thompson just had a profound impact in the style of college basketball that was played there and after.
All right. Unfortunately, we're going to have to call it short right there, but we appreciate your being here. Pete Thamel, Yahoo Sports reporter, joining us here on The Move. And as we head towards the commercial break, Want to let you know that right now markets are trading down. The S&P 500 is essentially flat, but the Dow is off about 200 points. The Nasdaq is positive. It is up a little more than 80 points. Much more on Yahoo Finance right after this.
Welcome into live market coverage here on the ticker. I'm Zach Guzman. Right now, the Nasdaq is the leading index to watch here, up by about 0.75% as we hit the afternoon trade. The Dow off by about that margin right now, and the S&P pretty much trading at break even. That index, though, trying for its 8th straight winning session. The last time we would have seen that was back in April of last year. But besides that, whether or not it even does end in the green, if it stays flat, that index still set for its best August in 36 years, just to show you how the month has gone for that broader index. And of course, right now, tech stocks leading the S&P right now on a sector-by-sector basis, up by about 0.5% there. Healthcare and utilities also in the green. The big tech stock to talk about today, I suppose there are two, really. Apple, though, will start the show highlighting those shares there as that 4-for-1 split takes effect. Of course, the weight in the Dow here falling from 12% to 3% for Apple due to that stock split. And right now we are seeing shares up by about 3.5%. And Tesla also seeing that 5-for-1 split take effect here. Shares there jumping as much as 9% earlier in the session. A couple of those boosts confounding a few investors out there, as we've discussed on the show. Not really much of a fundamental change when we look at those names, but nonetheless, maybe a little bit of a boost coming from a cheaper price point, making those shares a little bit more accessible for retail investors. It's also the first time we're going to see Salesforce, Amgen, and Honeywell shares trading as Dow components, officially replacing longtime components there in ExxonMobil, Pfizer, and Raytheon Technologies. And right now, though, I want to kick off the show with highlighting what we have seen in terms of the market trade here, as we have seen coronavirus cases drop over the last 7-day averages. We've seen that moving in the right direction. Perhaps highlighted, though, by Arizona. We've been highlighting the way that state has been reeling in case counts there. Down now 92% off its peak, even as we see the total case count for the country top 6 million. What does that mean for the overall market moves to watch here? That's the big question we're asking to kick off the show. And here to answer that for us is our first guest. Chris Payne is Payne Capital Management Financial Advisor, and he joins us now. And Chris, thanks so much for joining us. I mean, when we talk about it, it does seem like there has been a boost, and we've seen so many record highs set in the month of August. I think a lot of that does tie back to
to the idea that we are seeing the case count here in the U.S. improve. But when you look at it, we've seen a lot of the tech stocks leading this rally. I would just highlight that, I guess, when you look at the value sector there, you can look at SPHB, I guess, to kind of tie that in. When you look at the performance over the last month, tech, the XLK outperformed by a 2-to-1 margin. So what's your take right now on how investors might be leaning into tech and what you're seeing right now in terms of value stocks maybe being overlooked?
Yeah, I think, Zach, I think we've seen, 5 to 10 years worth of growth in a 3-month period as a result of the fact that that the coronavirus, I would say, is the primary culprit of that. But the way I look at it and the way I talk to my clients is that, the old adage is you buy low, you sell high. And I have to say, looking at growth right now, it's looking pretty high. Forward PE on growth right now is probably somewhere in the ballpark of like 30 to 31 times forward earnings. Whereas you look at things that are like more value based, they're trading closer to 18 times earnings. The way that I look at it is that, value, for example, right now is trading at a very low price, and not to mention you're getting great dividends. So in my mind, it's like you're getting really good prices. You're getting income, whereas growth doesn't really pay out much in the way of dividends. And from my standpoint, it's a great buy. Not to mention that over time, value actually tends to beat growth 67% of the time. On average, I would say it's probably somewhere in the ballpark of 4.5 times a year over what growth typically does.
When we talk about some of these names, though, too, that have been impacted by the coronavirus pandemic, I mean, you can look at a few of those, Carnival and Norwegian Cruise Lines. When we think about what's going on there, obviously there's some risk attached to those names, but I'd be curious to get your take on why we haven't seen, as cases have improved, why we haven't seen some of these value names catch a boost here. Do you think maybe investors are just bracing for what could come when we hit the fall and winter, and maybe that second wave that's pretty much, it's been talked about by Dr. Fauci, a lot of experts out there fearing that. Do you think that's playing into some of the reasons why we haven't seen that rotation happen?
Yeah, I mean, if you're talking specifically like about the travel industry, the cruise industry, I mean, I can speak for myself. I'm not really super excited to go on vacation somewhere, especially on a cruise ship, which historically are known to be a cause of spread of disease. So I guess that might be part of the reason why that industry hasn't recovered. I think it might take a lot longer for us to see those industries really turn around as a result of that.
Yeah, what are some of those value names then that you are watching that you do see value in here, whether or not maybe that second spike comes? Because we have seen a few opportunities outside the travel industry. Financials, maybe one that has not seen a very strong recovery here over the last few weeks. Where are you looking specifically?
I've never been one to pick individual stocks. I like more broad-based indexes. Like a Vanguard broad-based index. You're getting a broad basket of great companies. But to your point, like financials have really been taking a hit here. And I think even if we see like a little bit of a spike in rates, we could see those companies really start to recover.
Just backing up too, when we think about where we've come since those March lows, I mean, it's been fast, it's been fierce when we think about this recovery. But over the last few weeks, we've been discussing how a lot of the incoming economic data has not necessarily shown a strengthening recovery. If anything, it's very clear that it has been weakening. On that front, when we think about catalysts here over the next couple months, I mean, absent Republicans and Democrats agreeing to that fourth stimulus phase here, what are you really looking at? Because we've gotten pretty much the most accommodative Fed you can ever hope for if you are an investor out there. So what more has any hope to push the market even higher from here?
Well, I think one thing is, the market, I think, is smarter than us. The market's always forward looking. And if you look at it right now, there's more cash on the sidelines than there's ever been in history. And this even goes back to like 2009 after the financial crisis. So I think at some point people are going to get really smart and say, okay, I'm getting less than 1% on my return in cash. I really need to get some return out the market. And you're not going to get that in bonds. You're going to get that in the stock market because you're going to get growth. And then you're also going to get potential dividends.
I know when we're talking about all this too, it's strange to consider the fact that we're about to move forward here into September. We have an election looming. I mean, on that front, a lot has been made about the fact that the market does not enjoy close elections. The gap between Joe Biden and President Trump continues to narrow. President Trump gaining ground on that front. What do you think that adds in terms of the back half uncertainty and what could happen whether or not Joe Biden defeats President Trump? How does that factor into your investing thesis in the back half of the year?
Well, I think if you look at things more on a long-term basis, politics in general has very little long-term bearing on financial markets. And, typically after election, markets tend to fare well. I think, maybe the biggest changes we'll see is if the Democrats get in, will be some changes to the tax code. But I think as the past few elections have shown, I think the market probably will continue to continue on its path.
All right, then let's talk lastly about the real impact here of what a lot of people, whether you're Republican or Democrat, have been hoping for in terms of that next round of stimulus. We haven't seen those checks, even though that is something that they both agreed to. We haven't seen those $1,200 checks cut once again. We will be discussing later on in the show about states taking up the President Trump executive order here to start rolling out $300 to $400 in weekly benefits, though notably a little bit less than the $600 a week that we had seen before. Do you see that as something that the market may have already priced in here and getting some sort of a skinny bundled deal between Republicans and Democrats? And what might you see coming out of that and changing the way that we've seen the market trade here at all-time highs?
That's a good question, Zach. I think the benefit of potentially having another stimulus has hit the market, but I think that once that stimulus actually gets announced and we start to see that to happen, I think that's going to have a much greater impact and a much more positive influence on the markets as we see in the future.
Yeah, well, it's dragged on quite a bit. I know a lot of people out there are hoping it would have happened quicker than that. But Chris Payne, Payne Capital Management Financial Advisor, appreciate you taking the time to chat.
Thanks, Zach.
Well, whether it is tech or other industries here, we've seen the pandemic upend and shift the way American consumers shop and really spend a lot of their time. And one big benefiter from all this has been Wayfair. The e-commerce platform there has seen shares this year rise more than 200%. And the last quarter that they reported earlier in the month blew away expectations. And here to discuss that with us is our next guest, Seth Basham, Wedbush Securities analyst, covers the stock for us. And he upgraded Wayfair after their latest results. And Seth, it was pretty impressive to see this. I think the rotation into shopping online is certainly not new, but what they reported blew a lot of people away. Clearly, I guess you would be included in that camp. What's your take on how they might be able to capitalize on that moving forward, not have it just be one blip where a lot of people are at home saying, I need to revamp my house. What are you seeing in Q3 and beyond for Wayfair here?
Yeah, sure. Thanks for having me. We upgraded our rating on Wayfair prior to its last quarterly earnings report on the viewpoint that we're likely to see spending in this category, especially online, remain stronger for longer than the market does. And so far into the third quarter, we're continuing to see that based on our channel checks. There's a key spending shift that you referenced earlier that's benefiting these guys. The fact that people aren't spending their discretionary dollars on travel, entertainment, and restaurants and moving them to things that are home-oriented is huge for Wayfair because that's the category where they focus. The home-oriented retail category is less than a third the size of travel and entertainment spending. And if that travel and entertainment spending is down 50% or so, there's massive amounts of dollars that could shift to the online and just general home category. And Wayfair is the biggest beneficiary of that, being at the core of the intersection between online shopping and home goods. Into the third quarter, we're looking for growth that could easily be north of 60% year over year. That's a bit of a slowdown, of course, from the 84% growth in the second quarter, but still extremely strong relative to pre-pandemic levels. And we expect that to persist. The biggest categories of growth right now in the home are things having to do with home study and home work. Work from home, study from home is becoming a more permanent type of outcome of the pandemic in many consumers' eyes, and they're preparing for that accordingly. So people are buying desks, they're buying things that will support home offices and home libraries. That is going to be a big piece of the growth here in the near term, but there's such a broad array of merchandise that people are focused on that should carry Wayfair through in terms of spend levels over the course of the balance of 2020 and beyond.
Yeah, you upgraded Wayfair shares, as we said, but the price target jumped from 240 to 330. And on that front, I guess one of the big questions, as you lay out in your note, is the stickiness of customers here. In Q2, as our own Dan Roberts highlighted off the earnings call, Wayfair added 5 million more new customers in Q2 than the last 4 quarters combined. It welcomed back 1 million past customers who had not visited the site in over a year. So, when you think about that and adding new customers in Q3 and beyond, what do you think might be the swing factor there As we talk about the cost to acquire these new customers and advertising spend, and how a lot of people have stopped advertising altogether, what do you make of those costs for Wayfair in the back half of the year, and how it might be cheaper for them to maybe attract new ones and keep other customers shopping on the platform?
Yeah, I think the big is part of the growth story that people aren't completely recognizing here is the ability for them to take those customers they've acquired and drive additional revenues from those customers over time. The repeat purchase rates on those customers so far have been stronger than normal. And as you mentioned, customers who have left the platform are coming back more frequently. Customers who are on the platform are leaving less frequently. So they're not having to spend as much money to acquire customers for that reason, while still propel the top line growth. As it relates to customer costs, acquisition costs, generally, the company did benefit from a lot of organic traffic growth in the second quarter through the pandemic, as well as lower media rates. And both those things are likely to subside to a certain degree, but we do expect the customer acquisition costs will be lower year over year in the third and fourth quarters. But again, most importantly, it's how many dollars of revenue the customer will spend after they've been acquired and what that profit stream looks like to Wayfair.
Yeah, and on that front, I mean, obviously, Facebook has been making a big push into their own e-commerce efforts. They might have the added benefit there of already having a large network of users, and just adding a shop tab seemingly overnight is a little bit easier maybe for them to pull off here. But how might that competition interact here with Wayfair, not only just going up against Facebook, but Amazon, everyone else also seeing this e-com boost? What's your thing around how they're actually able to grow their share in the category?
Yeah, Wayfair has been able to take the most market share in this category of any retailer as it shifted online. Somewhere around a third of the dollars of growth of online home goods spending is going right into Wayfair's pockets. And we expect that to persist even with Pinterest, even with Facebook, even with others trying to pursue this category. Why? Wayfair is top notch as it relates to selection and service and merchandising. Price is also very competitive too. And the others can't offer those types of things combined the way that Wayfair can. So when you have a great experience at Wayfair, you're likely to come back more frequently. And that's what the company is seeing right now.
We opened this segment by highlighting the fact that shares are up more than 200% on the year, but it's even more drastic when you look at how it's rallied off those March lows, up by about 1,000% just since then. I mean, when we talk about valuation, I understand there's a lot of growth here for this e-commerce giant, but when you think about that, you talked about it in your note, in upping your price target valuation there at 1.6 times enterprise value to forward revenue. Historically, you note that it's topped out at 1.75 times on that same metric. So curious in your mind, I mean, when we talk about the market trading at all-time highs, the downside risks here in looking at a stock like this at such high valuations, how do you put that in context?
Sure. There's been a paradigm shift which deserves a higher valuation. That paradigm shift is the company's ability to retain the customers, as I talked about, which leads to higher levels of profitability per customer, and therefore deserves a higher multiple associated with that profit stream. If you compare the company's valuation to other e-commerce peers that we follow, such as Carvana or Vroom, for example, or Purple Innovation in the mattress space, they're actually trading at a relatively good multiple compared to the others. And I think that there's room for valuation expansion because of that fact as well. The stronger your profit outlook in terms of consistency, the stronger your valuation should be in this space, along with the growth rate. And we think both those things are moving higher, not lower, which supports the valuation here.
All right, Wayfair red hot and showing no signs of cooling. We'll see what happens there. Seth Basham, Wedbush Securities Analyst. Appreciate you taking the time to chat.
You bet. Take care.
All right, we're going to take a quick break here on the ticker. When we return, it's not just e-commerce catching a boost, but also grocery stores as Americans shift away from eating out at restaurants. We'll chat that trend with the CEO of Grocery Outlet right after the break. Stay with us. Welcome back to live market coverage here on the ticker. Of course, 2020 has seen some pretty drastic shifts in the way that Americans are out eating. Of course, restaurants and indoor dining had shut down in a lot of areas of this country. We saw a big boost for traffic to grocery stores, and no doubt that story playing out for our next guest here in Grocery Outlet. Dubbed the TJ Maxx of grocery stores, Grocery Outlet offers a flexible model here to get prices out there, generally about 40 to 70% below those of conventional retailers, according to the company. And we've seen shares there up by about 30% on the year. So what's going on here at Grocery Outlet? Here to discuss that with us is Eric Lindbergh, Grocery Outlet CEO. And Eric, pretty interesting numbers you guys reported in the last quarter. And you look at same-store growth doubling, more than doubling. Don't want to take anything away from you, versus last year, up 16.7%. Versus a 5.8% increase we saw in Q2 in 2019. So what do you attribute that to? I mean, obviously, across the board, grocery traffic's up, but what are you guys doing differently to get shoppers into your stores?
Yeah. Hey, Zach, thanks for having us on. I would say, look, we've been fairly boring in that we've been very execution based. We do a few things and do them really well. We find great deals for customers. And we do it across the board on, national brands, small brands, regional brands, all in the consumable and the fresh space. And we've just relentlessly pushed away at that for years. And I think what happened, people went to search for other places to find, supplies that were short, and they found Grocery Outlet, and I think they've stayed. So it's been a pretty frenetic growth pace since about March 15th, and it's held on pretty well.
People have talked about in this uncertain economic time, we've seen this in prior recessions, the idea of maybe bargain shopping and how that grows during times like these. I mean, you guys topped even the highest expectations out there for analysts in the second quarter. Do you see that trend continuing when we think about more people maybe being more conscious of price, going into your stores maybe for one or two items, and then replacing other trips to outside stores? I mean, how are you thinking about targeting that value shopper right now?
Yeah, look, I think we saw it in 08, 09. There was a deep reset to value coming out of the last recession. And I think we could be in store for something similar to that as people think about their highest expenditures in their household. Housing, food are up there, probably 1 and 2. And so as people look for value and where they're going to spend money, where they're going to save money, I think they think about what's their personal budget for food away from home and in home. And we represent, at least half of that, if not probably 60 or 70% today. And we offer that 40% savings to 70% savings. So people can really come in the store and use it as an effective tool against their home budget. And so we're reaching out to those customers through social media. We're an old, fashioned sort of brick and mortar retail. We don't do a lot online, and we have a lot of stores that are very convenient to get into. They're run by community, families, and people are finding them.
Yeah, that was going to be my next question, because we've seen that shift really intensify here, particularly in the grocery space when we think about either curbside pickup or a full delivery. You said on your earnings call that the strong performance in the first half of the year was setting you up to invest in the business. And I know you've been opening a lot more stores this year, but beyond that, what other initiatives are you looking at? Is curbside pickup maybe a little bit easier for you guys to roll out than delivery? Is that something on the docket?
Yeah, so look, I would say it like this. We are really focused on delivering value to the customer. The customer's not asking us for anything online. They represent or they recognize that I think value goes away if I start to deliver to their home. We think potentially you could do buy online, pick up in store, BOPUS. You could do curbside. We had a few stores playing around with it. I wouldn't say never, but I would say that the treasure hunt model that we have, the opportunistic product, the variability of what we offer store to store is really best experienced by the customer in store. And so for now, that's going to be the model for us, just to double down on value and really make sure we're providing that value in store.
And if you're leading with that, I mean, this treasure hunt kind of model, as you guys call it, and trying to find those bargains out there, I could see why that might be something that's a little bit A, less fun online, or B, harder to actually institute. But when you think about that, I mean, how does that shift as you guys work with more suppliers and grow your scale? How does that help you obviously improve your guys' metrics moving forward in the back half of the year?
Yeah, I would say, the larger you get, I think the more readily you're able to address the supplier's needs. You're offering more points of distribution, you're offering more customers, you're offering, essentially a faster turn for them. Essentially, we're talking about 1% of the CPG product in the US has to go through a channel like ours, a secondary channel. And so the faster we can turn products, the more responsive we can be, the better a partner we can be to them. The trend has been in the last few years away from the national brands into regional brands, smaller brands, brands you might find that are more natural, organic, specialty, healthy. And so we've launched an effort called NSA, New Supplier Acquisition, and we've got a team of people going out, looking for new relationships and new solutions for them. So it's amazing when you shop the store what you see in terms of brands and values, and the customers responding to it. And they love the variability. They love that it's a little bit more like a treasure hunt. There are wows down every aisle and every corner of the store. So it's really a compelling shopping environment.
Yeah, and a very interesting change in the dynamic here, as you highlighted there, in terms of the value shopper becoming even more important. We've seen it before, we're seeing it again. But Eric Lindbergh, Grocery Outlet CEO, thanks again for the chat.
You bet. Thanks, Zach. Take care.
All right, we're going to take another quick break here on the ticker. When we return, more drama playing out in the feud between McDonald's and its ousted CEO, while the company is slamming him as, quote, morally bankrupt in that saga. We'll have all the updates right after this. Welcome back to the ticker. The case between McDonald's and its ousted CEO and Steve Easterbrook is heating up here as the company attempts to claw back more than $30 million from the ousted CEO over that case of inappropriate relationships at McDonald's. And here for more on that, we're joined by Yahoo Finance's Alexis Keenan, who has more details on this. And Alexis, it looks like it's getting personal.
Pretty personable. I would say that the calling Easterbrook morally bankrupt in one of these filings goes to that length. And if you remember, Easterbrook was ousted from McDonald's in November by the board over what was thought to be a one singular, non-physical, intimate relationship with a subordinate employee. After learning of the additional relationships, allegedly, there are 3 more that Easterbrook had ongoing but didn't disclose. McDonald's then sued to claw back the severance agreement that they made with him, this multi-million-dollar severance package, saying that they never would have granted it if they knew that full story. Instead, they said that they would have fired the CEO for cause, which would have made him ineligible for any type of severance package. Now, Easterbrook is asking the court to dismiss this case, but in this new legal filing today, McDonald's lawyers responded. That's where that language was calling Easterbrook morally bankrupt. The company has also said that when asked about employee relationships with subordinates, that Easterbrook didn't disclose all of them when he was specifically asked that. Now, that's an allegation. We haven't heard his side of the story. Also in their complaint, McDonald's had said that he lied to McDonald's investigators, and the way they put it is that he concealed evidence. So although Easterbrook said he deleted from the mobile phone these relationships, some of them are of a texting, sexting, if you will, nature. Although they were deleted from the phone, in these new documents, it said that the emails and that some of this information was still on, perhaps even the texting as well, was still on McDonald's servers. And therefore, Easterbrook is arguing that he should be able to keep this severance agreement. So perhaps kind of a stretch there, still a lot more to learn in this case.
Yeah, where does it go from here, though, when we talk about the case being argued back and forth? I mean, a lot of these details, I'm sure, if you're in his shoes, would not have wanted to come out in the first place, but in trying to battle for $37 million potentially in this package, what does it look like in terms of defense and where we go from here?
Yeah, so that makes this case a little bit special. Usually these types of matters are handled in private. This time McDonald's chose to wage a very publicly natured breath of fresh air, I guess, or maybe not so fresh air, by filing this in a court of law. It's in a chancery court in Delaware. That's a court of equity. But what happens from here is, now that Easterbrook has filed a motion to dismiss, they also have filed a brief, and also McDonald's has responded. The judge will take a look at that and figure out whether the grounds that are presented there are adequate in order to toss the case out of court, or even perhaps to another jurisdiction. That's another one of the things that Easterbrook is asking for here, to get it out of that Delaware court. So still a lot to go here, and certainly a lot more to hear from Easterbrook to try to defend these claims.
And very interesting in terms of precedent set in the Me Too era for a company going beyond and actually trying to take the action to claw back some of that as new details come out. But Alexis Keenan, appreciate you bringing us that. We're going to take another break here on the ticker. When we return, digging into the way that one restaurant here, beyond just the big players and the big franchises out there, is grappling with the pandemic. We'll chat with the CEO and founder of Raising Cane's Chicken Fingers to check in on how they're battling all this out and why they're seeing business come back to potentially what we saw before the pandemic hit. We'll chat all that. Stay with us. Welcome back to live market coverage here on the ticker. Of course, we've been highlighting the way that different restaurants have been grappling with the pandemic. We saw indoor dining shut down across most of the country here. And some Americans have been trying to get accustomed to the new changes that we've seen play out here. No doubt the drive-through lane has been as busy as ever. And for more on that and other changes being instituted to make this a successful recovery in the pandemic, we're joined by the founder and CEO of Raising Cane's Chicken Fingers, Todd Graves, that joins us once again on the program. And Todd, I'd like to say it's good to see you, but every time we have you on, I just want Raising Cane's, and there's none here in New York for me to have. But it looks like you guys' business has recovered to the pre-pandemic levels you saw here. How is that possible, and what have you seen in terms of making customers more comfortable and continue to deliver and on what you guys set out to do through all this?
Yeah, Zach, the last time, well, we got some rainstorm here in Louisiana, but the last time we talked, we, Raising Cane's, when COVID-19, the pandemic hit, we went down immediately 30% in sales, which for a growing business like mine, you are just bleeding cash and you're really in a bind. And 30% has been our number for dine-in and takeout. And so when that went away immediately, we were down 30%, which is exactly those numbers and that format that our customers use us. But then they quickly, over the course of about 30 days, shifted to go towards drive-through business. So about 30 days into the pandemic, we got our original forecasted sales back, and then from that point, we actually went up in sales that we had originally forecasted pre-COVID.
And I guess it seems simplistic, but it's something we've talked about in terms of cuisine that holds up through this. I had seafood the other day. It was takeout. It was garbage after it finally got home. We've seen Papa John's Domino's shares up 40, 50% this year. I mean, chicken seems to be perfectly suited here, I guess. And we've seen the boost. It's been a year since the Popeyes Chick-fil-A drama played out. I don't know if you're still seeing a boost from all that, but it's an anniversary. I didn't realize we just passed 2 weeks ago. What do you think that maybe did to the idea of chicken being more popular for a family dinner in terms of the takeout options?
Yeah, I think people are shifting towards the complete meal focus, right? And so it's not just a burger or sandwich at lunch and do something else for dinner. I think chicken's the great protein to do dinner as well. And it was very interesting when Popeyes and Chick-fil-A went back and forth with the chicken sandwich. You think that would take sales away from other chicken competitors like Raising Cane's, but it's a rising tide lifts all boats. Everybody in the chicken category did better because people were paying more attention to chicken, right? Our chicken sales went up, which is really interesting.
And the one thing we were discussing, kind of a debate before we had you on, was that you do have a sandwich on the menu. It's technically 3 chicken fingers on a bun. We were debating whether or not that's a sandwich or not, but what is that? Maybe did it spark any talks about menu innovation at Raising Cane's? I mean, you guys have a pretty concentrated menu here. What does that say about maybe the model and stresses that might be changed if you ever added anything to the menu?
You're talking blasphemy to me. I'm the Raising Cane's chicken fingers, one love, that quality chicken finger meal. I haven't changed the menu since 1996. And we believe at Cane's you do one thing and do it better than anybody else. And because we have that system, right? It's that cook to order system. We can get that food out with fast food speed and convenience, but with unbelievable quality. And when you start changing menus and messing with it, you mess up with your speed or you mess up with your quality. And it's working right now, so we're gonna stick with it. Actually, I like to offer that chicken sandwich to our customers because some people just want that sandwich, but it actually takes us a little longer to make that sandwich. So I'm not really crazy about it being on our menu in the first place.
Now, when we talk about doing things and doing them well, though, I mean, we've highlighted so many businesses laying off workers through all this. You guys managed to not lay off any of your crew members, even as you saw hours cut. Now you're distributing more than $5 million in thank you bonuses to your crew members. How have you been able to do all that when you think about, I guess those thank you bonuses would be making up for the lost hours, but how is that kind of the right model for you guys as a business to maybe, stick together through it and not deal with rehiring on the back end as you see business pick back up?
Yeah, I have to say this, we're actually doing better since the pandemic, and we're not really happy about that because we have this thing, someone explained to me the other day, survivor's remorse, right? We're seeing these other restaurants that don't have the drive-through format just really suffering and closing. But we think it's our mission and it is our privilege to serve our customers and have a great place for people to work. And so because of this drive-through format and because our teams really rallied, we were able to go up in sales. And because of that, we were able to pick up a lot more crew members. We hired actually to the tune of 8,000 new crew members since the COVID 19 hit, we were able to open 15 new restaurants. During that time, we plan the next 150 restaurants coming up here over the next year and a half. And so it's just, taking advantage of the opportunity we have. And really, that's just what we should do. With other people losing their jobs at other restaurants, we should be hiring them, but these teams are working exceedingly hard. They're working so hard. We're running quad shifts during the day, which means we have 4 different shifts of crew members, different crew members on each shift. So if one crew member on a certain shift were to catch COVID, and to be a potential spreading that through our restaurants, these teams don't interact with each other. So we can get another shift to go in and handle that shift while we quarantine the crew members. It's very hard to do. Our managers are just really tired at this point, but we all believe it's our mission, and it's our mission to do this because when we went into this, and really during the first 2 weeks, we knew how bad it could get. And we knew it could potentially mean that Raising Cane's could have to furlough crew members, let crew members go. And I just rallied around that cause of no crew left behind. And it just came to me. And when you rally our team around a mission that's bigger than all of us together, everybody works so hard together, including crew members volunteered cutting their hours some so that everybody could keep their job. And then we were fortunate enough to get our sales back. And that's why we did the $5 million bonus to get everybody caught up and then also get a little bit ahead.
Yeah, which is very different than a lot of the other decisions that we've seen playing out here. But to the last point, in terms of seeing your business pick back up, I'd be curious to get your take on maybe how some of these might be permanent shifts. If you are saying maybe people are more comfortable with the idea of chicken as a takeout order versus some of these other things. I mean, when dining eventually, hopefully, opens back up, what are you expecting to see in terms of how Americans might shift some of this? Because we've talked so much about now grocery orders going up and people cooking at home. But what are you expecting to see when things do return back to normal?
Yeah, I mean, I think people are going to go back to dining rooms. You're seeing it when anybody opens up their dining room to half capacity, they are full, right? I talk to fellow restaurateurs all the time, and they say the demand is there. So I do believe people are going to go back into restaurants, but I believe they're going to go back to the restaurants that they have full trust that people are going to be CDC compliant with COVID-19. You're seeing it like crazy. I think part of Raising Cane's success with our customers is they know there's a founder behind it, and they know I feel responsible. I feed people's children. I employ people's children. And I think they're going to go to the restaurants that are doing the right thing they are with the health departments, et cetera, et cetera. I think restaurants that don't do it are gonna not only keep closing now, they're going to close in the future. There's going to be new innovations, plexiglass shields, like in the drive-through. I think it's a good improvement to our business. You're going to see a lot of that stay. Touchless payment is here to stay. Mobile ordering is going to do nothing but go up. People are going to not want to have, they're going to want to limit their transactions, but they have to actually touch hands and potentially spread germs between the two.
Yeah. No, it's a very interesting takeaway too when we think about some of those other restaurants out there that have invested in very much those policies and those changes over the last few years, clearly paying dividends here as well. Todd Graves, appreciate you coming on as always. Next time you come on, you got to have one a little bit closer because you can't drive to Boston for Raising Cane's every time here, man.
I'm already looking for locations since the last time we talked. You're going to be pleasantly surprised the next time we talk. I'll have some good news for you.
All right, appreciate it, Todd. Be well.
Okay, thank you.
Meantime, when we talk about other employment picture topics out there, not all restaurants clearly going the way of Raising Cane's. We've highlighted over the last few weeks the rising unemployment claims out here, jobless claims, and what that means as we saw the CARES Act benefits roll off at the end of July. Some states now have been rolling out the benefits under the Trump executive order there, tied up to about $300 or $400 a week in terms of additional benefits. We're already seeing that come out now. And for more on that, we're joined by Yahoo Finance's Denitsa Sikova here with the details. And Denitsa, when we look at it, 6 states doesn't seem like a lot, but at least I guess it's a step in the right direction.
It is. It is indeed a step in the right direction, but there are a total of 48 states. So 6 out of 48, we're still very early in the process. So 6 states, these are Arizona, Louisiana, Missouri, Montana, Tennessee, and Texas, have started distributing those. In some states it's 300, in others it's 400. And they're part of the WASP Wages Assistance Program, or the famous memorandum signed by the president. But for many states, this may not happen until September. Like we know for Maryland, we know for Colorado, they say late September, mid-September. And just a reminder, the 600 under the CARES Act expired at the end of July. So that means people are left without extra benefits for like at least 2 months. There is back pay, but there is the question of how long the benefits will last. So
yeah, And that's really the thing here too, as you highlight, 48 states here in the process of unloading and setting up the system here, since it's around the unemployment systems that states use. But when you think about that money, I mean, obviously it's a step down from the $600 you're talking about under the CARES Act. I mean, 300 or 400 states have the option in working there. What have you seen so far in implementing the system so far?
Well, the majority of the states are opting for the 300, which is a logical option if they have the two options, and this is just the cheaper one, and their budgets are already in a very difficult situation. And what the memorandum does, it provides 300 benefits from the federal government, and then states can match the 100. But we only have Kansas, Kentucky, Montana, Vermont, and West Virginia, so just 5 states out of 48. That are going to pay the 400. And that's another thing about that lost wages assistance program is like very unequally distributed. What we had under the CARES Act is no matter which state you live, how much you make under unemployment, you get the flat 600. While here, if, for example, in South Dakota, the governor declined the benefits, so people will get no extra benefits.
Yeah, which is interesting just when you think about that $300 level, about an 85% wage replacement when you ask some economists there. Obviously, still a bit of a step down from that 600, but we'll see what happens. Denitsa Sakova, appreciate you bringing us that. We're going to take one more break here on the ticker. We'll have much more on the trading action to highlight right after this. Welcome back to the ticker. 2020 has been a very unique year for travel. We've already seen air travel fall considerably here in this year, but that hasn't stopped more Americans to get out on road trips and stay, perhaps maybe at a hotel, maybe at an Airbnb, maybe at a listing on Koala. The startup there specializes in timeshares and lets people who have timeshares list their properties. And we've seen them grow through all this. I want to bring on the CEO and co-founder of Koala, Mike Kennedy, joins us now. And Mike, I mean, talk to me about how what you guys are offering here is different, since I know timeshares could be on Airbnb. It's not necessarily what they're known for. So what are you guys doing differently on that front?
Sure. Thanks for having me, Zach. And yes, like you said, Koala is a state sharing marketplace that offers, timeshare owners the opportunity to rent to anyone in the world. And it's a unique platform because it's specialized for the timeshare product. And the timeshare product is unique because it is a true hybrid of hotel meets home. I think there was a lot of startups that kind of talked about being this hotel meets home aspect, but timeshare is like the only true natural hybrid. You have elements that are resort amenities. You have things like a living room that you'd find in an Airbnb. All of those elements really combine to make timeshare a very, very unique proposition for travelers today. Typically you have this kind of bifurcated option when you're looking to travel. You're like, okay, we have a family of 5. We're looking to go into cram into a 1 or 2 hotel rooms because we want resort amenities. Maybe we don't trust Airbnb, or you go the Airbnb route where you get all the amenities of the home, but you don't have that certainty of the hotel. And timeshares are that one true product that combined the best of both of those things. It's essentially why timeshares have been so successful as a selling product for so many years, and we're just bringing it to a marketplace that wouldn't necessarily be maybe open to buying it, but as a vacation rental, very much so.
Yeah, I know your background was at Hilton Grand Vacations. You spent a lot of time there. I mean, when you think about having a platform dedicated to timeshares, I mean, I've seen some of those listings that more resort style, which is very different than what you see on an Airbnb, mostly homes. So how does that maybe, how do you market that specifically? What's your core demographic versus maybe people who are more looking for an Airbnb?
Well, sure. I mean, I think, Airbnb is, essentially we're like the Airbnb 2.0, right? Where we're looking at young families that grew up using Airbnb and peer-to-peer sharing economy platforms like Airbnb and VRBO, but maybe they have a young family now and they're looking for more certainty when they're traveling, but they still want that value that the sharing economy provides for them. So that's certainly one of our target demos. The millennial family generation is growing. I think 48% of millennials now have kids. They still love to travel. They don't want to own things. So the proposition of maybe owning a timeshare is not necessarily very relevant to them, but certainly staying in one, again, as that hybrid product is very appealing to them.
During the pandemic, when we talk about the growth of people listing their properties, it was interesting. Airbnb just released this today saying that they had 200,000 new hosts welcomed guests during the pandemic, their first guests. What have you seen in people listing timeshares on the platform and how maybe that's risen or not risen during the pandemic? And what are you doing differently to attract those timeshare owners?
Well, I mean, yeah, we've seen a growth in supply acquisition as a result of COVID. I mean, timeshare owners are like anyone else. They bought it to travel, and in many cases, they're senior citizens and are potentially more at risk as a result of COVID. So we're seeing an absolute spike in supply acquisition. The traveler has been a little bit different in terms of their behavior. They're booking very last minute things. We're seeing a lot of staycations. We had a booking that they were actually in the resort and they wanted to stay another week and they booked it again. So you're seeing very different behavior from the traveler perspective. But on the owner side, the acquisition on the owner side it's actually spiked because as a result of COVID. Because I think, again, there's a lot of uncertainty in travel and people still have these maintenance fees that they need to cover. So it's definitely solving that pain point for them.
Yeah, and if you can't use it, you might as well list it out there and have someone enjoy it.
Yeah, for sure.
Appreciate that. Mike Kennedy, the CEO and co-founder of Koala. Thanks for joining us there, and good luck.
Sure thing. Thank you.
Before we go to break, just want to highlight the moves that we're seeing right now in the Nasdaq, up at session highs, now up more than 1%. The S&P, we did see the tech sector there, Leapfrog Healthcare as the highest performer today, the strongest performer, being led here in the tech space. Just got to highlight session highs here for Tesla and Apple, both shares seeing a big boost after that 5-for-1 split in Tesla and 4-for-1 for Apple. Something we talked about for weeks leading up to this, and clearly we're seeing that payoff, whether you think it's any fundamental change or not. Big boost there. We're going to take one more break here on the ticker. When we return, discussing the latest thinking at the Fed. Again, reminding investors they are nowhere near raising rates. Stay with us. Welcome back to the ticker. Again, we are hearing from the Fed that they are nowhere close to raising rates, this time coming from Fed Vice Chairman Richard Clarida, saying that the rates won't go up just because we might see unemployment fall. Again, reiterating to investors, they're not close to it. And here for more on what that means is Yahoo Finance's Fed reporter Brian Chung. And Brian, I mean, it's like a broken record at this point, but really putting the message out there, they're not raising rates anytime soon.
Absolutely. And this comes after that big Jackson Hole speech from Chairman Jay Powell last Thursday, where the Federal Reserve said it was going to overshoot its target on inflation. Keep in mind, the Federal Reserve has been targeting 2% inflation, but the Fed now saying they would basically keep a monetary policy accommodative translation, keeping rates near zero until it can see prices going above that 2% mark, which means that it could be for a lot longer than it would be under its previous framework. So you had Vice Chairman Richard Clarida speaking at an event this morning, hammering that point home yet again, saying that really the previous framework that the Fed was using had some faults of its own, saying that at sometimes the approach to maximum employment before the Fed made this change can and had been wrong. Vice Chairman Clarida is saying that more specifically, it was the Fed's fear of raising rates due to fears of inflation, really, that kind of changed and underscored the tweaks that it made to its framework last Thursday. So Vice Chairman Richard Clarida really underscoring here that the Federal Reserve has more room to do things if it does need to, although they did rule out things like negative interest rate policy and yield curve control, at least for the time being. So the Federal Reserve saying, look, for right now, we do plan on continuing to provide accommodative monetary policy, but make no mistake, we are far from running out of ammunition if things do end up getting worse.
Yeah, I mean, I was surprised, were you, to hear him? I guess we've heard that before, even from Jay Powell, beating back the idea of negative interest rates. He stressed that he doesn't think that that would be an effective policy tool to implement here. But beyond that, yield curve control, we've talked about that and waiting in the Fed's thinking to really study that and get a new statement or policy position out on that. Are we surprised to hear some more of that from Clarida?
Not necessarily. I think the Federal Reserve has been pretty clear that for right now, they feel comfortable with what they've been doing, which has been a lot, by the way, slashing interest rates to near zero, expanding their balance sheet to $7 trillion, launching 11 different types of liquidity facilities. But the Fed has said that it's been thinking about whether or not it needs to use other types of tools. But as I mentioned, ruling out negative interest rate policy, also ruling out, at least for the time being, yield curve control. But again, the Federal Reserve trying to say we're not considering those, but they might still be on the table if things get really, really bad. So Federal Reserve saying, look, we're not out of ammo yet. We still got some power left in the tank.
Yeah, and certainly that would be a big piece of ammunition to use, something we haven't seen before. Brian Chung, appreciate that. That'll do it for us here in the 1 p.m. hour on the ticker. Stay tuned. We got much more coming your way right after the break.
Welcome to Yahoo Finance. I'm Kristen Myers, and you are watching The Ticker. Taking a look at the market action today, the S&P 500 just flipping into the red right now. So the Nasdaq, the only major index in the green right now, up about 1%. The Dow down about 0.75% right now. The S&P 500 and the Dow, although they are both in the red right now, are still headed to wrap up the best August in some 3 decades, 36 years actually, to be exact. Now, the S&P 500 is actually up 7.2% on the month. The Dow up nearly 8%. Again, these are the biggest gains that those two indexes have seen since 1984. And we also have two big stock splits starting today. That's both Apple and Tesla. Taking a look over at Tesla right now, that stock up right now about 10.5%. Looking over at Apple right now, up 4.7% right now. Also want to give a look over at Virgin Galactic. They actually received a bullish call today and received an outperform rating. That stock right now is up 2%. And some interesting news from Amazon. That company has now actually won FAA approval. That's the Federal Aviation Administration for drone delivery trials. So you might see some drones delivering those Amazon packages sometime soon in the future. That stock, again, up right now about 2.25%. Now, looking over at the Yahoo Finance heat map, there's a bit of red across that screen today, as we had seen tech stocks had been in the red, now, of course, flipping somewhat into the green right now. Again, Apple leading the way there, up almost 5%. We've got Netflix up about 1.5%. Facebook, the big laggard on that group, up about 0.5 percentage point right now. Now, when it comes to stimulus talks, there is sadly not much to say there. Democrats say that the negotiations can continue only when Republicans at least agree to a more than $2 trillion price tag. Now, I want to talk about coronavirus. We have some sad news there, at least when it comes to the case counts in the United States. We have now crossed a 6 million case count threshold. Now, for anyone that has been tracking this, when I was last hosting this show, almost about now a month ago, we were at a 5 million case mark. So about 1 million cases being added over just the last several weeks. Now, the death count in the United States up over 180,000 as we are barreling towards a 200,000 death count. Globally, India right now has a record for the highest number of daily cases. That country right now is actually third when it comes to the death count. They are, of course, behind the United States right now. And when we're looking at stateside, when it comes to the coronavirus cases, New Jersey has decided that they're going to be reopening restaurants for indoor dining at least at 25%. That's starting just this Friday ahead of the Labor Day weekend. We actually have some more news on New Jersey that we'll be chatting just a little bit later in the show. 6 states have also set new record daily highs: Virginia, Kansas, Kentucky, Iowa, Indiana, and Minnesota. So we are seeing the coronavirus start to surge and really spike in the Midwest. So let's jump in right now, straight into the market moves with Alfred Eskander, SALT Financial President and Chair. Alfred, so I'm just kind of wondering if you can give us some of your thoughts on the broader market right now, especially after seeing this record August. S&P 500 and the Dow both up almost 8% this month. And this, of course, as we have coronavirus cases spiking and other headwinds.
Well, if you were just to look at the performance of the indices over the last 5 months, you wouldn't think that this is a global pandemic going on. There are businesses, shut down, some permanently. The S&P is about to have its 5th consecutive month of gains. And obviously, as you know, it's in record territory. So there's definitely a very disconnect between day-to-day life reality and what some of these indices are doing so far this year.
Do you think the market is stretched right now? How much?
Well, it's not so much that it's stretched. I think the biggest issue for investors is fear of missing out. And what you have right now when you've got the indices in record territories and stocks, continuing to do really well, you have to take a closer look. Which of the indices that are really performing and which ones are lagging. Of the 11 S&P indices, you still have 5 of them in negative territory. That being said, the news on the market is it keeps going up, up, and up. And what investors really have to do is protect themselves from a potential drawback. We've seen it in March. We have an aging population that still needs to fund its retirement. And with the treasuries yielding where they are, they're going to be pushed into equities. So the big question is, how do they protect themselves? And as you know, we've got a huge volatile event coming up in November, which is the presidential election. And uncertainty will bring with it volatility. So investors really need to think about how to protect the gains that they've enjoyed so far, and what products that they could use to help them do so.
So Alfred, you're already hitting on several things that I want to get to with you. First, I want to start with a correction. I've been hearing a lot of folks talking about if a correction is looming, if there's one imminent. Are you seeing it the same way?
So, at SALT, we're a quantitative analytics and index business. So we don't look at particular single stocks. We kind of look at the overall market, and certainly measuring and forecasting the volatility within that market to help investors kind of pick their point. So risk control and volatility control is really what we do. And a lot of companies out there with some products that are available to retail investors that mimic kind of what institutional investors do. For example, you have buffer ETFs that give you some protection from that expected, pullback. You've got, another series where you've got products that dynamically hedge, your exposure, which is, an ideal way to get some protection. And you also have products, for example, from Pacer that will switch you out of an equity position into a 3-year month treasury, which is obviously safer to avoid that anticipated pullback. We see products like this, risk control, vol control products, definitely much more in demand now than they have been in a long time. And that's because people want to protect what they have and certainly put a little more defense in their overall portfolio.
Okay, so to that point, and you talked about the FOMO of investors right now because they've been chasing gains. And we've been chatting about the rotation in the market, these value investors getting a little bit more aggressive. Tech, however, right now, up over 10% for the month. I mean, honestly, if you're looking more at those value stocks, don't you have to reconcile with the fact that you are just frankly going to be giving up some of those gains that are probably inevitable to come over the next month or so?
Well, I don't know any investor that ever admits that they chase performance, but they all do. And, it's a habit and certainly an act that we're all guilty of, including me. But when you look at the technology sector, which makes up the majority of the S&P, it's up over 34% so far for the year. That's a tremendous amount of gain, again, especially in this environment. So being able to protect that gain and control some of your risk exposure going into the fourth quarter is something that we definitely see a lot more advisors talking about and asking us, sort of guidance on some of the products that they could be using.
So before I run out of time with you here, Alfred, we've been talking again, record month for the S&P 500 and the Dow. What are you expecting for September, especially as the election is going to be drawing nearer and nearer?
So the one thing you could certainly expect, and we have confidence, in sort of forecasting this, is you're going to have more volatility. Now, you're certainly going to have big down days as well as big up days. And it takes a really strong stomach to kind of stick with it. When you're chasing performance, you tend to get in high and wind up getting out too early. So discipline is important, understanding the level of risk you have in your portfolio and knowing what tools are available to help kind of dial that up and dial that down is going to be really crucial in the fourth quarter.
All right, we'll have to leave that there. Alfred Iskander, SALT Financial President and Chief Operating Officer. Thanks for joining us.
Good to see you again.
And as I mentioned earlier, coronavirus cases have now topped 6 million. And so, of course, as I had said before, that means we've added 1 million cases in some 3 weeks. So to chat more about this pandemic, we're joined now by Dr. Michael Gonzalez, emergency physician in Houston, Texas. So doctor, we're seeing the case counts climb in the Midwest. I had mentioned at the top of the show that we are seeing them spike in Kansas, Kentucky, Iowa, and others. We've added, again, 1 million cases in just the last month. I mean, is this pandemic as you're seeing it, is it growing? Is it slow? Are we slowing it down at all, or is it starting to speed up?
Hi, Kristen. Thank you for having me. I think that's a really difficult question to answer. And I think what we're seeing is a lot of the regional influence. And the United States is a large country, and we've really gone through this in a series of waves. And so in Texas in particular, I think we're starting to see the hint of some optimistic findings in that we are seeing a decrease in our hospitalization rates, a decrease in utilization of our ICU beds. But our positivity rate is still kind of hovering above the 10, 12, 15, on certain weeks, 17%. And really, we all know that we would really ideally like to have that below 5% before this thing can be anywhere close to what we would say is controlled. And I think some of the areas that you mentioned, certainly, I think the coast went through it before Texas did. Texas is still in this sort of middle phase where we're very concerned about what future might lay ahead. But I think they're experiencing the lag of the surge that we sort of felt a few months ago. We were really at the very peak of our hospital utilization rates, where we really had very few beds to spare in the larger metropolitan areas at least.
So case counts spike around Memorial Day, Independence Day. We now have Labor Day coming up, but it seems as if people have only gotten increasingly restless over this summer. Are you concerned that we're going to be seeing another uptick after this holiday weekend?
Absolutely. I think the major holidays are certainly areas of concern for us on the front lines, no matter where you are. And we have definitely seen, it's been all over the news, areas that have been less careful with distancing and mask wearing. Those things will continue through the holidays, and Labor Day is coming, as you mentioned, and some of the major holidays with extended periods of time, family gatherings approaching in the fall. And those are huge areas of concern for us on the front lines. I think the biggest question for all of us right now, particularly in Texas, a few of our local schools have started to open, but really the bigger, larger metropolitan areas are largely starting after that Labor Day holiday. And I think that remains the biggest question. We know our kids are certainly the thing that we care the most about in this world. I have 2 school-age children that, we've been monitoring very carefully about the plans for our organization and our local school district. But I think knowing that kids can carry this virus and can sometimes be labeled as relatively asymptomatic spreaders, the problem is that they go home. Right? In very simple terms, they go home and they interact with teachers who may be among some of the more vulnerable parts of our population. And so to me, the holidays are a known quantity, and we know if people practice those things, social distancing, mask wearing, that we can weather those things. We made it relatively well through some of those holidays in Texas, but the schools, massively reopening the schools, especially your elementary and middle schools, where those kids are going home every single day, remains to me the biggest question mark.
I want to ask you as well about New Jersey and some of the moves that they have been taking recently. They're going to be opening up indoor dining again this Friday. They'll also be opening up their movie theaters. And the governor there, Governor Murphy, has also decided to raise the indoor gathering limits. So church services pushed from 150 to 150 people, or 25% capacity. That's also going to exist for films and indoor performances, theaters. When you hear an announcement like that, how worried do you get, or do you think that that is completely the wrong decision that the leadership of any state should be taking right now?
I think that they are incredibly optimistic decisions to make at this point in time, given the caseloads that we're still seeing. Now, I will say that even in my own state, Texas has been at a 50% occupancy rate for restaurants for some time. And although we are by no means out of this woods, I think we have made some progress in sort of seeing some stabilization. So my argument always, when I get the chance to either speak to members of the media or elected officials at different levels, is always really sort of a cautious, sort of stepwise approach is what I think most of us on the front lines would recommend. Mixing one or two additional variables into any scientific experiment is always the way to do it, so that you can measure that outcome. Doing all of those things simultaneously, watching from far away, I can only be concerned about what might happen in New Jersey based on what I've read about the plan is for reopening those different entries, particularly the indoor large group gatherings. We know based on the little research that we have on this novel coronavirus is that those are the highest risk activities, particularly if there's no adjoining mask requirement that comes along with it.
All right, well, we'll have to see if the New Jersey governor is listening to you and some of your advice. Dr. Michael Gonzalez, emergency physician in Houston, Texas. Thanks for joining us.
Thank you.
And after the break, Nestle is going to be pushing more into the health sector after they plan to purchase a peanut allergy treatment maker. That's next. Welcome back to Yahoo Finance. Checking market action right now. The S&P 500 has actually flipped right now into the green, up about 1 point right now. The Nasdaq up about over 115 points right now. That's 1 percentage point. The Dow, of course, the only major index right now, in the red, down about 0.75 percentage point. Of course, we were talking a little bit earlier about how Tesla and Apple have actually initiated their stock splits. Tesla is up right now over, well, actually nearly 10.5%, excuse me. Apple remains up over 4.5%. Now, when you think of Nestle, I'm sure, like many others, you think a Toll House chocolate cookies or Nescafe instant coffee, or of course, the Kit Kat. But now you should also think about health. The food and drink conglomerate is set to purchase Immune for some $2 billion, which is going to give it full ownership of its peanut allergy treatment. So we're joined now by Greg Behar, CEO of Nestle Health Science, and Jason Dallas, CEO of Immune, and of course, our own Anjali Kamlani. Greg, I want to start with you. You guys say that the peanut allergy treatment alone has a potential of $1 billion in sales. But even beyond that, how much potential are you guys seeing in food allergy treatments going ahead?
Well, the food allergy space is tremendous. 240 million people in the world suffer from food allergies, and peanut is the number one of those. So it's more than a billion in opportunity. The allergy in general, food allergy, keeps growing. And so Immune Therapeutics has also additional products in the pipeline. So it's a very exciting day today because we're basically adding a leading company in nutrition and health that already has a footprint in food allergy, Nestle Health Science, with one of the most innovative company in food allergy treatment, Immune Therapeutics. So it's a very exciting day for patients and for the food allergy solutions and products in general.
Jason, Anjali here. I'm curious about, what you've seen in terms of competition in this space. I know that the FDA rejected a patch earlier this year from another company, but in the process of, gaining the FDA approval for this, what have you seen in terms of what's expected in the space going forward?
Yeah, so Anjali, it's quite astounding that it's 2020 and this is the first time ever anything has been approved to treat any kind of food allergy. This is just astounding in today's world with all the technology that we've got and the advances we made in other parts of medicine. The reality is that Palforzia, which is the product that we have approved for the treatment of food allergy, is likely to be the only player in the food allergy therapeutic market for some time. That being said, we've taken our own platform on which Palforzia has been founded and built and developed, and we're extrapolating that through now to other food allergies. So we have a program going on in egg allergy. We actually have a program going on in multiple tree nut allergies because we know many folks suffer from more than one of those at a time. So our goal here is to continue expanding this technology into different kinds of food allergies, but we expect our technology to be the only one out there as an approved therapeutic for the foreseeable future.
Thanks. And Greg, looking forward, you've had a stake in the company for some time. Why convert to an acquisition now?
Well, we've been working with Immune Therapeutics for 5 years. I was on the board of the company. We were in a development partnership for 5 years, and we've made 4 stages of investment in the company. The fact that they have an approved product now, FDA certified, I would say, with great science supporting it, and on top of that, that they are continuing to progress their pipeline. And we see, some good traction in the market, a very good feedback from patients and healthcare providers. This is an ideal time to combine our forces and continue to grow this amazing opportunity.
I think it's interesting looking at, how some parents and how patients have dealt with this for some time when it comes to introducing, right, the allergens into the system. Some people say that it's easy to just do it with, say, some flour or something like that. Why is it such an important treatment, and why would someone want to do it, considering the backdrop of a very sensitive healthcare space right now, pricing especially?
This is a very, very important question. The concept of this kind of treatment is called immunotherapy, and what it means is you give very, very, very small doses of the thing that the patient is allergic to and slowly increase this over time. And you eventually get to the point where step 1 in that treatment objective is the ability for your child to re-engage back into society with a high level of protection, that if they somehow come into contact, in this case with peanuts in any form hidden in whatever they may come into contact with, that they're not going to have a life-threatening allergic reaction. So step 1 is protection. But maybe even more important than protection is the ultimate goal here, which is remission, or essentially no longer being allergic. And for folks who've had allergy shots, they'll be able to tell you that that's a sort of 3 to 5 year proposition, at which point your allergist will stop you and say, you're no longer allergic, you don't need your shots anymore. And we believe that over a period of time, the same thing will happen with immunotherapy for food allergies. Today, we have 2 years of data, and the data suggests we're well on that march. That immunomodulation that has to happen is happening. We're not quite there yet. Is it going to take 3 years or 4 years or 5 years? We don't know, but we do believe we're going to get there. And the really critical thing that you've touched on, Anjali, is the need to have exactly the same allergen and the same dose of allergen for that entire period. If you go into the store and you buy 2 different peanut flours, there can be a 400-fold difference in the amount of allergen and the type of allergen in those 2 different flours. So if you keep taking different kinds of peanuts in different ways, the likelihood that you're going to get to that remission downstream is extraordinarily low. And I think that's the promise of this therapy as a biologic medicine rather than as a food.
Jason, I just had one quick question for you. Coronavirus has largely taken the wind out of everyone's sails, perhaps, in the therapeutics and pharmaceutical companies that were working on other things and not a vaccine. I'm wondering how the virus is impacting the business and particularly Palforzia.
So Kristen, right at the very beginning, so we got approval for Palforzia at the end of January. Our first patient was treated on Friday the 13th, and on Monday the 16th, the national emergency declaration went out and all the shelter-in-place orders started. And the challenge that we had at that time in the launch is that, like allergy shots, the initial doses of Palforzia need to be given in the allergist's office. And so what we saw through March and April was essentially a very big slowdown in allergists even being open. The truth, though, is that about 80% of allergy is practiced out in the community and community practices rather than in hospitals. And what we've seen since the end of May is these allergy practices open up again. They're figuring out how to see their patients and how to do their work within the context of the coronavirus. And things are slowly starting to return back to normal, if you like, for healthcare, maybe not quite at the cadence or at the throughput that you would have seen before. The other thing that's playing into this is the fact that schools may not be going back as quickly as they could be going back. And actually, this is an opportunity for parents to have their children go through this updosing phase of the treatment while they're at home and while they can take care of them. So by the time they go back to school, they're at their maintenance dose and they have all the protection that they need.
All right. Well, this is, of course, very exciting news for parents and children that are suffering right now from a peanut allergy, and anyone else that might be watching that has food allergies. Potential treatments possibly on the horizon. Greg Behar, CEO of Nestle Health Science, Jason Dallas, CEO of Immune Therapeutics, and of course, thank you as well to our own Anjali Kimlani.
Thank you both.
Thank you both.
Now, as the summer comes to an end, so does the summer driving season. So we'll be chatting oil right after the break. Welcome back to live market coverage here on Yahoo Finance. Checking market action right now. All three major indices, mixed bag right now. The S&P 500 and the Dow, both in the red right now. Of course, those two indexes heading for a record-setting August. Some of the biggest gains in over 30 years. Now, the Nasdaq, of course, is up about 1% right now. We are seeing tech stocks in the green. Apple right now, they had initiated a stock split for today, up over 4.5%. Facebook up almost 0.5%. Netflix right now up nearly 1.5% right now. Looking over at oil, down over 0.5% right now. So let's keep that conversation going. We are joined now by Patrick DeHaan, Gas Buddy, Head of Petroleum Analysis. Patrick, you know, the last time I had been chatting oil on this show was just 2 weeks ago. I mean, we've been talking about the OPEC forecast, worse than previously feared for the year. For 2021 had remained unchanged. Since then, however, we've seen Hurricane Laura. I'm wondering what you are predicting for oil prices ahead of Labor Day and into next year.
All the more impressive that for the last 9 weeks or so, we've been stuck in this range of 41 to call it $43 a barrel. Where we go from here on out, well, we're continuing to watch the recovery in coronavirus, not only in the US, but global economies. Oil demand here in the US is starting to sneak up, though, of course, with the end of summer driving season here in the US, we do have some headwinds that are going to start blowing fairly strongly. Gasoline demand tends to ease up in the US after the conclusion of Labor Day weekend. So oil may be hard pressed to find a strong footing to continue a rally this year, barring any sort of major breakthrough with coronavirus, like a potential vaccine.
Are you seeing any upside really for gas prices going forward?
I think moving forward, Hurricane Laura really was a small catalyst for prices. That's why we saw the national average perk up here by about 4 cents a gallon in the last week. It stands now at its highest level since March. But with the conclusion of Labor Day weekend, we will likely see gasoline demand go down. And really looking at our Pay with Gas Buddy data on gasoline demand, which looks at the retail level, we are now in our second straight week of demand that's fallen off ever so slightly, down about 2% week on week. So gas prices should start to lose momentum before they start declining, maybe 10 to 20 cents a gallon by Halloween.
So I know that you're talking about the demand right now declining going forward, but I'm curious to know, just because we're seeing people getting a little bit restless because they've been stuck in their homes, they've been wanting to travel. Folks are chomping at the bit, checking which countries they could possibly visit. More and more countries are opening up. We are seeing airlines see more and more passengers. Is there at all any kind of hope that going into this holiday season that people are just so fed up of being at home that they're actually just going to take to the road and take to the air?
I think we've almost been seeing the behavior describing this cabin fever stronger now than we usually get at the conclusion of winter. So there is a tremendous interest in getting out, but I'll note that a lot of airlines are still kind of in this cutback mode. They still have very liberal cancellation policies that reflects that there's a lot of people that are still very nervous. And of course, like you mentioned, travel restrictions acting as a big headwind on jet fuel demand. Of course, if you can't go to Europe, if you can't go to Asia, jet fuel demand is really anemic across the board. And actually, that's one of the products out of a barrel of oil that's faced the most challenges. So there is interest there. I think we continue to see U.S. coronavirus cases go down. That's maybe positive. But now, of course, in Europe, they've seen an upswing. So how long are we going to have this looming over us? Could be many months before we see notable improvement.
So we've seen that the U.S. supply had been declining for quite some time, of course, easing the global glut. Do you see that trend continuing for much longer?
I think so. Now, keep in mind, we've just had Hurricane Laura, which shut down potentially hundreds of rigs in the Gulf of Mexico, which limited oil production here in the U.S. the last few weeks. That should keep oil inventories from really seeing a big surplus again. Last week, oil inventories, by the way, declined close to 5 million barrels. So combined with the increase in demand from several months ago, we're starting to chisel away at some of those surplus inventories. But again, heading into the fall, we could start to see those numbers go back up. And of course, OPEC continues to closely monitor the situation. They want to ease up. I think OPEC is very happy with oil prices where they are. It's not high enough to justify U.S. producers getting back online, but it's low enough to incentivize consumers to start returning to the road. So that's an interesting dynamic to keep an eye on as well.
All right, Patrick DeHaan, Head of Petroleum Analysis at Gas Buddy. Thanks so much for joining us today.
My pleasure.
And after the break, we'll be talking a new year-end target for the S&P 500, but how high? You'll have to wait after the break. Welcome back to Yahoo Finance. Checking market action right now. We are seeing a mixed bag as the S&P 500 and the Dow remain in the red. The S&P 500 down about 4 points right now. The Dow down about 240 points. The Nasdaq, the only major index right now in the green, up just under 1%. Now, the level for the S&P 500 right now is just over 3504. Of course, it had opened a little bit earlier today at a high of 3509. But our next guest says that this is nothing because we could be seeing a level of 3650 by year end. So we're joined now by Brian Belsky, BMO Capital Markets Chief Investment Strategist. So Brian, the S&P 500 record gains for August, up over 7% for the month, an impressive rally. But what are you seeing right now that makes you say 3650 by the end of the year?
Well, thanks for having us. We've been very consistent in our bullish call. In fact, I believe, as I wrote in my piece that was published on Friday, that the March 23rd bottom, which when we wrote that piece that day, we said that stocks would rally 40 to 50% from the low. So we thought that, number one, we needed to provide more guidance. Number two, we suspended our year-end target at that point, which was 3,400, given what was happening, or really for all intents and purposes, not happening with earnings. We said that, that was the control alt delete for the market and really ushered in the second half of the 20-year bull market that we originally called for in 2010. So again, what does that mean? Coming in the timing of publishing this report was really off the heels of additional Fed testimony that really backed up the notion that the Fed's going to have the accelerator on for a while, number one. Number two, when growth is scarce, growth outperforms. So I continue to believe that the names that have been garnering momentum will continue to have momentum, but we are going to have some broadening out. Doesn't mean that financials and some other areas can't do very well. It's just going to be very select financials, the ones that are, oh, by the way, growing the best or have the best strong or best cash flow and best earnings. So I think what's going to end up happening is 3650 by year end, and in the next 12 months, we revised our 12-month target to 3850. The skies aren't always blue and the screens aren't only green. We are going to have some volatility. Of the, let's say 100 clients that I spoke to today, quite frankly, Kristen, 95 of them are negative. 5 of them are bullish. They all don't believe the rally, most of all because they missed the rally in March because of a lot of the scare tactics by a lot of my compatriots out there with respect to these, what I like to call bombastically negative forecasts in terms of the world going into the Great Depression and things like that. And I think it's really because we focus so much on the negativity in investments the last 20 years. We feed on that negativity. We don't believe. We have to have faith when we invest. And from every bear market, every recession, we come from despair to hope. And as we transition from the chaotic beginning of COVID-19 to more coping and coexisting with COVID-19 and all the other variables that we're now living with, I think the U.S. stock market, is the best position to labor that.
So let's talk about those two things, hope and despair. On the hope side of things, is it just momentum right now, or do you see some kind of large catalyst coming up that could, make this market go even higher?
Great question. The catalyst is we have the best companies in the world here, and I think they were under-owned, and we had at one point close to $4 trillion in money sitting on the sidelines. We had a lot of foreign investors, quite frankly, Kristen, that did not participate in the 2019 rally, let alone the move off the lows since March 23rd. Also, if you take a look at what's happening fundamentally and how strong the consumers come back, consumers still 70% of the economy in the United States, and how strongly the tech and communication services sectors, even before COVID, became the quote unquote, as I like to call them, the consumer staples of this new millennium. We're all buying iPhones, we're buying the Netflix machine, we're on the Google machine all the time. And that's what we're spending our money as a consumer. So they were strong before COVID, during COVID, really the height of COVID. We think they're going to be stronger heading into the end of this over the next 12 months. So that's enough catalyst, I think, to continue to catapult U.S. stocks higher.
All right, so we might be ending here. Let's end it on despair. I should have flipped them the other way around, so at least we could end on a high note. But what are you seeing as some of the biggest risks, some of the biggest headwinds going forward to that target level that you guys have set?
When everybody's talking about the same thing, Kristen, meaning a second wave coming, an election risk, go the other way. That's what I would say. When everyone became super bullish, that's when I'm going to be worried, and we're nowhere near that.
All right, Brian Belsky, BMO Capital Markets Chief Investment Strategist. Thanks so much for joining us today. And after the break, we're going to be chatting TikTok. That deal could be announced as early as tomorrow. That's next. Welcome back to Yahoo Finance. Checking market action right now. All three major indices remain a mixed bag. The Nasdaq, the only major index right now in the green, up about 1 percentage point right now. S&P 500 and the Dow, though, they are headed towards a record-setting August, the most gains for both of these indices in some 36 years. They are both in the red right now. The Dow down about 0.75 of a percentage point. The S&P 500 fairly flat right now, down almost 2 points right now. I want to give a look over at Virgin Galactic. That stock up about 1.5% right now. We will be chatting them in just a couple of minutes. But first, let's talk TikTok. A deal in that company could be coming as early as tomorrow, as China could potentially throw a wrench in that plan. So for this, we're joined now by Michael Baker, Managing Director and Senior Research Analyst for D.A. Davidson. So Michael, I want to start off on first the bids that we've been seeing for TikTok. There's two different ones. You've got Oracle in one corner, and then the Walmart Microsoft bid over in the other corner. Who do you think right now might be the preferred buyer?
Well, it's hard to handicap it, but I do like the two-pronged approach that the Microsoft and Walmart bid comes from, where you have the technology component and the consumer component. So I could see how that would be potentially attractive for the TikTok platform.
So when it comes to at least that corner right there, Walmart and Microsoft, I think a lot of people heard that Microsoft was interested and they said, yeah, that makes sense. And then Walmart decided to get involved and people were scratching their heads a little bit. I'm wondering if you can highlight how this would be a great deal for Walmart.
Yeah, well, so on the surface, they certainly do seem to make strange bedfellows, that is TikTok and Walmart, and it's sort of hard to imagine Sam Walton involved in TikTok. But when you think about it a little bit more, it really does make perfect sense. One of the things that Walmart has been emphasizing and focusing on, of course, is growing their e-commerce platform. And that includes growing things like their marketplace, similar to Amazon's third-party marketplace, and their advertising business. And those are things that Walmart has been talking about for some time. And the TikTok platform would help propel them in that area. So in that sense, it really does make a lot of sense for Walmart, even though initially it does seem a little bit strange.
Does this at all change how you're approaching Walmart in terms of price target?
Well, so we like Walmart, have liked Walmart for some time. And this just enhances our view of the company. One of the drivers for our model this year is reducing the losses in their e-commerce business and moving that towards profitability. And this type of deal would help them move towards that. If not this year, then in the coming years, certainly go from a loss to a small loss to break even to, at some point, having the e-commerce business drive revenues. In terms of the cost, one thing that I found really interesting is that in the second quarter of this year, Walmart ended with about $17 billion in cash, and that's up almost $7.5 billion versus a year ago. So in some ways, they just would be spending back some of the windfall that they've made from their strength over the last year to finance this type of deal. So it is a big deal, certainly, but it certainly is something that Walmart could absorb, and again, would enhance the margin profile.
So I want to talk about the deal itself, because it seems as if it could be getting a little bit more complicated, because now China has said they want to say and who's going to get to buy the company, that they're going to have to offer a license for TikTok to even sell off its US operations. One, what does that mean exactly, that this licensing? I know that their export laws are now getting involved. And do you at all think that it could maybe not scupper the deal, but at least delay it?
Well, suffice it to say that it does make it more complicated, yes, and it probably is delaying it and causing some of the bidders to go back to the drawing board and figure some things out. So hard to say if it completely scuttles it and what exactly it means, but it certainly does make it more complicated. And I'm sure the players right now are going through those scenarios and trying to figure out how that changes their ability to purchase it or what they're willing to pay. Based on how much benefit they can derive from the platform with these types of changes.
And I'm wondering, in your mind, what do you imagine, excuse me, this sale could look like? Because TikTok is a tech company. One of its big assets, of course, would be the code. A little bit difficult to kind of split that in half, just to say that they are selling off the US operations, the way things are so interconnected. I'm wondering how you think that TikTok is going to be doing that going forward. Are the engineers going to be going with the deal and with the sale? Usually employees go with you when you sell a company. How do you imagine that this deal is going to be getting done?
Yeah, way beyond my pay grade to figure out how the technology is going to split, how TikTok is going to split their technology up. But I would be confident in saying that if Walmart and Microsoft combined are going to bid for it, then they're going to get they're going to get in the deal the assets that they'll need to run TikTok appropriately. Again, from a technology standpoint, beyond me, how TikTok would split that up.
I mean, I had to ask Michael, because I have no idea how that's going to happen. Last question here for you. I mean, obviously, tensions between the US and China have been getting fairly tense as of late and over the last couple of months, particularly as the pandemic had started. I'm wondering if you think that China might use this as some sort of leverage, this sale, to get something from the US government, the buyer perhaps?
Again, that would make sense beyond my pay grade, but it certainly makes sense that within these negotiations, both sides are going to try to extract what they can from it and use whatever leverage they can. And so it does seem like China's playing a card now to try to increase their leverage and maybe get a better deal for themselves.
All right. Well, we will leave that there. Michael Baker, Managing Director and Senior Research Analyst for D.A. Davidson. Thanks for joining us today.
Thank you.
And after the break, the sky's the limit for Virgin Galactic. That's next. Welcome back to Yahoo Finance. Let's talk Virgin Galactic. That company right now is soaring, especially after Cohen has decided to see a lot of potential. So for more on this, we're joined now by our favorite tech expert, Dan Howley. Hey, Dan.
Hey, how's it going? That's right. We're seeing some shares of Virgin Galactic improve, and that's because it's getting a kind of upgrade from Cohen here, basically pointing out that there is a greater appetite for these kinds of ventures from consumers. This is, of course, a commercial spaceflight from Virgin Galactic, that ship that will take you up to, the outer limits of the atmosphere. I believe to get there, they drop you off of a ship, and then that rockets you up. So that sounds nice and terrifying, but it seems as though it's something that a lot of people are interested. So far, there's estimates that they have about 600 reservations, but the prices for tickets are going to be astronomical, no pun intended. And the issue there would be, how many people will actually want to do this over time? How sustainable of a business is it? And then obviously, we're looking more and more to the future where we could see additional forms of hypersonic travel and things along those lines that may enter into Virgin Galactic's resume. So that could be something where we see growth down the line. But yeah, I mean, we are seeing this upgrade, but it's not exactly the kind of business you would think many people would be able to enjoy.
Well, they did say in their note, Dan, that, people seeking luxury experiences would be very interested in Virgin Galactic, although it does sound completely terrifying to me. Well, thanks for that, Dan. And in what could be incredibly bad news for anyone out there searching for a job, new data from LinkedIn shows that ghosting, that is, of course, when someone originally starts talking to you and then completely disappears, is pervasive among employers. So for more on that, we're joined now by Yahoo Finance's Sabeel Marcellus. Hey, Sabeel.
So the coronavirus pandemic has caused tens of millions of Americans to lose their jobs. The job search is very difficult. And what we're seeing here with new LinkedIn data is that 93% of job seekers are saying they've been ghosted by an employer. And that is after an interview or after that employer asked them for additional information. Now, I spoke to a LinkedIn expert about this, and while ghosting is not a new phenomenon, many single millennials are familiar with it. They like their crush doesn't like them, moves on, but doesn't pick up the phone to let them know that. So employers are actually doing this too with job seekers. And job seekers, it really has hit a nerve. And on LinkedIn, they've posted comments talking about how this makes them feel. And many job seekers say that they feel that it's unprofessional, that it's disrespectful, and even cruel when employers do this. And I want to pull up this comment that a job seeker put up that kind of summarizes how many feel. He said, quote, "The vast majority of us are looking for a career to sustain ourselves, support a family, and build a financial future. This is not a game for us. Complete the process and follow up with the candidate. It's also the right thing to do." Now, I should note that some recruiters also weighed in, saying that it's not necessarily that the recruiter wants to ghost you, it's just that they have so many job applicants, the unemployment rate is so high, they just don't have time to get back to you. But of course, for some job seekers, that response is just not good enough. I asked a LinkedIn expert, what do you do if you get ghosted, if you're still looking for work? He said that you can follow up to 3 times, but stay cordial in those follow-ups. And he also said, just don't give up on the search, keep looking.
All right, Sabeel, I have one question for you. I know you're saying that ghosting has become increasingly, I guess I'll call it popular ever since the pandemic hit. Was it as pervasive prior to the pandemic? Have employers just always been this fickle in responding to job seekers?
Well, it depends on the company. So different companies, different cultures. If you're a job seeker, you would hope they would have the courtesy to let you know, especially after an in-person job interview, that they have moved on and that they're no longer considering you. But it's become more pervasive since we've seen the pandemic happen. More ghosting by employers.
Yikes. When people thought that dating was hard, well, apparently so is job seeking, especially right now as millions, of course, are on unemployment. Thanks so much, Sabeel. And taking one last look at the markets right now, S&P 500 has managed to flip back into the green, up over 0.05% right now. So the Dow is the only major index right now in the red, down over 0.5 percentage point. The Nasdaq has been in the green all today, up over 1% right now. Now, of course, even though the S&P 500 and the Dow have been flip-flopping out of the red, those two major indexes right now are headed to wrap up the best August since 1984. The S&P 500 up over 7% for the month. The Dow up nearly 8% for August. Stick with us. The final round is next.
All right, good afternoon, everybody. Welcome to the final round here on Yahoo Finance. Miles Other with you in New York. Let's take a look at the markets here on this Monday afternoon, another day, and tech is leading while the rest of the market lags. The Nasdaq right now up more than 1%, record high for the tech index. The Dow off about 0.6%. The blue chips off 186 points this on the day that we see that new construction of the Dow 30, and we'll talk about that in just a bit. The S&P 500 is trading back above 3,500. A positive close on the S&P, of course, will be a record close after the S&P closed at a record high each trading day last week. Taking a look here at the S&P sectors, little surprise on today's session. We see XLK Technology, the leader, up 0.8%. Interestingly, communication services, which has a couple of the FANG names in there, new sector, of course, as of I think a couple of years ago, off about 0.2%. Healthcare and consumer discretionary, as well as utilities, also higher during today's session. Energy materials and, of course, financials lagging among the major S&P sectors. But let's talk a bit about kind of this reconstruction news. Of course, in the Dow, we've got a couple of new members today, but really all that shuffling is due to what's happened over at Apple, where that stock is now trading on a split adjusted basis, a 4-for-1 stock split affected at today's market open. The stock is up 4.5% on that news, $130 a share. Remember, Apple shares were around $500 last week pre-split. And then let's look at shares of Tesla. The stock right now is up 11% after that stock split 5-for-1. Tesla shares back at nearly $500 a share, which would have seemed crazy on a non-split adjusted basis just about a year ago. But again, that stock was north of $2,000. And just to put kind of the split in perspective here, the 52-week low on shares of Tesla, split adjusted, is $43.67. Right now, the stock is trading at $495. So stock's up 10x. No big deal. That's just the way that things go in this kind of a market. For more of today's market action, though, I want to bring in my co-host, Shauna Smith, joining me for the next couple of hours. Shauna, just what stands out to you in today's market action? I think, again, kind of a another day where tech leads, but really, in my mind, the only story is about the weird action we're seeing in the split adjusted stocks.
Yeah, it is certainly very interesting because we've been talking about the fact that fundamentally nothing has changed with Apple or Tesla. And you and I have said that multiple times. Jared has said that multiple times. Yet we're seeing this excitement and euphoria around these names. Now, historically speaking, this is normal. It's not totally uncommon for us to see excitement here from investors when we do see a stock split. But just the level of excitement, I think, is something that we certainly need to draw attention to. And you mentioned that 11% jump that we're seeing in Tesla today, that nearly 5% jump that we're seeing in Apple, and investors just continuing to find reason here to buy these names. And because of these stock splits, obviously these two companies now more affordable just on a retail level for investors to get into. And there is something attractive about being able to hold an entire share of a name. We would talk about the fact that investors are still able to get fractional shares. I invest in them through ETFs, but being able to hold a full share of Tesla or Apple obviously is enticing some new buyers here into today's action. But broadly speaking, Miles, the other big news of the day is this change that we're seeing in the Dow. We talked about it last week, but Salesforce, Amgen, and Honeywell now officially included in the Dow. These are three new stocks added today. The action on the stocks, not a whole heck of a lot going on. Amgen is basically flat. We're seeing Salesforce fractionally lower here, off 0.2%. But remember that record run that we saw in the stock at the end of last week on the heels of their earnings report. Honeywell off just around 1.5%. But I think the real focus is this diluted impact that we're seeing from Apple on a day where Apple is up 4%. Historically speaking, we will be just, I guess, more used to having with Apple having a bigger impact on the Dow. But again, today, since we do see that stock split, Apple just trading at $130 a share, obviously not adding as much into the Dow today. And then also just on a monthly basis, and I know Jared is going to go a little bit more into this here in a few minutes, but we started the month talking about seasonality, how August typically isn't historically a great month for stocks, but this month obviously proving that that is not the case. I think everything in the norm has kind of been thrown out the window in this uncharted territory time period that we're in right now. But the S&P up more than 7% this month, on track for its biggest August gain in 36 years. The same story for the Dow. So I think the question is, as we look to the fall, just whether or not this momentum that we've seen really carry over the last couple months is going to continue here over the next several months, because there is a lot of uncertainty when you think about just the latest with the virus, but then of course the election and what that means here for the broader markets.
Yeah, well, let's bring in Jared Shaw on that point about the month of August. And I think, I forget who we were talking to last week. Someone mentioned, well, don't forget September, a seasonally weak month for the markets as well. But Jared, we talked 4 weeks ago about all of the different August surprises that the market has had in store. I actually would classify 2020 as an August surprise. It just happened to be in the complete opposite direction, I think, of what many investors had been braced for at the beginning of this month.
Yeah, we talk a lot about seasonality, and it is applicable. It can be responsible for up to 30% or roughly 1/3 of the stocks or an indices price movement. But, there's 2/3 left. And so we got other fundamental factors at play here, like FOMO and TINA and all the other 4-letter acronyms that we like to spout about here. Let's take a look at some of the charts. This is the S&P 500 for the month of August, if I can get it to come up here. And we're going to see that the S&P 500 is up about 7% for the month. The Nasdaq is up nearly 6.5% for the month. Nasdaq is up over 8%, and the Dow is up almost 7%. So pretty constructive price action here. And Friday, we're looking at the VIX because it was net up for the week in a week when stocks were net up. And we can see for the month of August, and I think this will be more clear in a candlestick chart. There we go. We had this big spike last, I believe it was Thursday, and kind of settling a little bit higher here, even though most of the indices, except for the NASDAQ, actually the S&P just turned green here, a situation that we want to keep following. And then the year-to-date chart, more instructive. This is just a little blip, so nothing too alarming just yet, but we do want to monitor that. And then the 10-year T-note yield, which has been trending up, and we'll get a closer view on this, is down today. It was down 3 or 4 basis points and it paired some of those losses, but we are trending higher here. And then finally, the dollar. The dollar is an important macro driver. We have it weaker today, right around these 2-year lows. And gold really not making much of it. It's up about 12 basis points, but silver now has broken to the upside. And let me get a 2-month chart here. And we can see this consolidation that was taking place. So now we are up and away after having consolidated for a better part of most of the last few weeks here. So the next price target on silver is 32. And of course, there's always Bitcoin as well, up 20 basis points today, but not quite over 12,000 again.
All right, Jared Blickery, with everything going on in this market, Jared, we'll talk to you in about a half hour. I want to quickly stay with what's gone on with the stock splits of Apple and Tesla, the stock reaction today. I want to bring in Dan Roberts and Melody Hom on this topic. And Dan, we talked about it last week. I guess the kind of question is it stupid that this is happening or is it fine? Because in this market, that feels like the answer or that feels like the question to be asked about almost anything. And this stock split, I think, kind of fits in the same bucket.
Well, I don't think it's stupid, but I will echo what Sean has said. And it's something we've all said in our discussions about these two names in the last few weeks. Nothing is new here. There's nothing new to like about these names that hasn't been the case for months and months, even before the pandemic. Now, of course, some analysts whose bullish notes we've discussed and dissected would disagree. You know, for Apple, they'd say, well, there's the services and the ecosystem and the subscriptions and excitement about the 5G phone. Well, we were talking about that back in January before there was a thing called COVID-19. And for Tesla, there's, the battery, supremacy, the idea that even Tesla will become, if you're not going to buy a Tesla car, maybe soon it'll be supplying its batteries to other EV makers. And that could be a huge business for it. And now also with Tesla, it sounded a little bit like Apple, you're hearing about the software and excitement around the software. Meanwhile, how about the cars themselves, which are also selling well? Great. But none of that is new. Now, I remember when these companies announced their stock splits, I think Tesla's was first, we talked about, well, why? Why are they doing it? And it was, it felt like a joke to say, but now in hindsight, it kind of feels like it was the biggest reason. It was an appeal to the young, new, sometimes stupid retail investor, a little bit to the Robinhood bros. And it's not just young men, it can be young women, but people who wanted to get in here. And it's a way for them to buy Tesla. I mean, it made the stock more accessible to new investors. And clearly, you reshuffle and now it's going up again. So I think we can't put aside that was part of the motivation here. And then, of course, we also talked about how Elon Musk, I think, just likes to do things, just likes to be noted and be in the news. Oh, Musk did another thing. This time it was a stock split. Well, it's gone very well for now for those two names. It's not stupid, but I do think it's, I understand the people, including my dad quite recently, who have said, wait a minute, unemployment is still 10%. Tons of people still losing their jobs, but stocks are going up. What's the deal there? Well, they're kind of separate, not that related anymore.
Oh my goodness, so much to unpack here. I do have to say the counter argument here, Dan, is that even the stock split, to Miles' earlier point, now at $500 a share, we were on the couches at Wi-Fi AM saying that even $500 a share was ridiculous, right? That it's impossible that this valuation could actually match reality. But at the same time, I mean, I may be airing my dirty laundry here, but my fiance was not into Tesla at all. And then he kept asking me every day, right? He is that, I don't know if you want to say stupid. I don't know if you want to say just like the layman, everyday man who was monitoring the stock saying, Melody, should I get in? I mean, is it going to go up? What's happening here? Okay, why does every day leading up to the stock split, this feels like I need to get in now? I'm like, it's so late. It's so late. And then I think he didn't listen to my advice. And now every morning he wakes up saying, wow, look at the stock price now, Melody. Like, why did you dissuade me for so long? So again, perhaps TMI, but I do think that's indicative of the kind of general confusion, but at the same time, the marketing sort of acumen that folks like Elon Musk, Dan, to your point, and Tim Cook have been able to do, right? They're able to gin up this story saying, you need to get in on this action, and we are democratizing it for you. Although I have to say with fractional shares now available on Robinhood, that doesn't really seem to compute in my mind, but it's really a different story. The same thing with Bitcoin, right? The idea of owning a full Bitcoin, the idea of owning a full share of Apple or Tesla, there is a sort of psychological satisfaction that you're able to get. So I can't really blame the investors for wanting to take part in this sort of kind of exuberant environment, if you will.
Well, and to that point, both companies explicitly said in their announcements that they wanted to, this is why they were splitting the stock, is to allow people to have more access to shares. And as you know, Melody, you could get it fractionally through Robinhood, but I think it does matter to some people to have the actual share and not have a claim on a share. Of course, a stock is a derivative anyway, so why would you want a derivative of a derivative? And also, and we don't need to go into all this, finance theory would say that if anything, the stock price should go down when it's split because there's no, like more people can buy it, so there shouldn't be a premium for a higher price versus, like it might not have been $1,000, it was only $1,000 because fewer people actually had access to that kind of money, so on and so forth. So in an interesting twist, things go the exact opposite of how any textbook might predict. Another wrinkle in 2020 once again. All right, let's turn our attention now to what's going on in the pharma world, of course, with the world of coronavirus, and a little outside news today on the vaccine front, but not a treatment or vaccine for COVID, but for one of the most popular childhood allergies. Anjali Kemlani joins us with that latest now. Anjali.
Thanks, Miles. Yep. So really quickly on the COVID front, we've definitely seen some progress when it comes to the treatment, as well as the vaccine spaces. And Novavax out with an announcement that it will have a deal, or it is in the initial state of a deal with Canada for doses. Of course, remember that's one of the largest recipients of federal, U.S. federal funding for the vaccine effort, as well as GlaxoSmithKline with Vir Biotechnology with that monoclonal antibody entering phase 2-3. So as you remember from last week's discussions, sorry, it feels like last year, the idea that antibodies are one of the key sort of bridges between vaccines and treatments right now. So very important to keep an eye on that, as well as Gilead Sciences getting an expansion on its use, emergency use authorization for remdesivir, which, as we know, has become almost normal usage for patients who are in the hospital right now. Initially, it was just for severely ill patients, of course, while doses were still limited, supply was still limited, and now the FDA has expanded on that as it has become part of normal medical protocol. So in addition, we have some non-COVID news. Peanut allergies, as we know, one of the most common ones. One of the treatments, or a treatment rather, was approved earlier this year, just before the lockdown. And so what we saw was this one company, Immune, that has been working on getting approval for a number of years, had a stake in it from Nestle Health, got a chance to finally get that on the market. But just as medical offices were closing down, take a listen to CEO Jason Dallas and what he had to say about the progress since then.
What we saw through March and April was essentially a very big slowdown in allergists even being open. The truth, though, is that about 80% of allergy is practiced out in the community and community practices rather than in hospitals. And what we've seen since the end of May is these allergy practices open up again. They're figuring out how to see their patients and how to do their work within the context of the coronavirus. And things are slowly starting to return back to normal, if you like, for healthcare, maybe not quite at the cadence or at the throughput that you would have seen before.
So as you can hear, things are starting to pick back up as we start to see offices reopen. Nestle, again, initially had a stake in the company and then has now converted that into an acquisition of about $2.5 billion. And so that's something that is certainly going to be interesting to watch. As we know, deals have been sort of on and off throughout this pandemic.
All right, Anjali Kemlani with all the latest there. Anjali, we'll talk to you in the next hour. All right, coming up on the other side of this break, Cowen out initiating coverage on Virgin Galactic, calling space the final luxury frontier. We'll talk to the analyst behind the call coming up here in just 2 minutes. right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. It's time now for our call of the day. And today we are talking about Cowen's initiation of coverage on shares of Virgin Galactic. The firm rates the stock outperform $22 price target. And we're joined now by Oliver Chen, an analyst over at Cowen on the team that worked on this note. So Oliver, let's just kind of start with the highest level thesis here on what you guys see as the biggest opportunity for Virgin Galactic and why you're so excited about the stock here.
Yeah, hi, Miles. Thanks for having us. We're excited to be here. So this company is really unique in that it combines the valuable Virgin lifestyle brand equity with proprietary technology developed with the $1 billion of investment made to date in vertically integrated aerospace development capabilities. So these three things combined really present a unique opportunity, and there's lots of existing demand. They have 600 future astronauts who've secured their spots. This is a luxury good. It's $250,000 to take a ride on the spaceship. And also, this is early stage. There's no revenue generation yet. So there's lots of catalyst ahead. But as we look ahead, the future of retail, the future of luxury goods is actually not goods at all. It's experiential. Less is more, and rethinking luxury in terms of the experiences you have, this fits in quite nicely.
And so, you mentioned that the company hasn't generated any revenue yet. And yet in the note here, you say you think there's visibility to being positive on a free cash flow basis in just 5 years. How quickly, I guess, and do you expect, and I guess the answer would be fairly quickly, but what's the kind of stylized timeline, I guess, you have on when we're going to see Virgin sending folks to space and seeing that deep reservation list, I guess, start to actually get run down here?
Yeah, Miles, a key catalyst is Sir Richard Branson flying in 2021, and then commercial space flight for guests starting sometime after that, late 2021, 2022. And we have that ramping up to $1 billion of revenue by 2030. You are really constrained by the number of spaceships. For example, we have the capacity growing to about 3,000 guests over time just because the spaceships can't do more than 5 flights per month. So there's a big supply constraint, and that's another hallmark of luxury goods. As we did a consumer survey at Cowen, there's as many as 2 million plus people who have the money and who are interested in this opportunity. A lot of demand, and it will be supply constraint. And as we break down the numbers, there's two parts to this business: the commercial space flight business, as well as a high-speed point-to-point travel opportunity, which is a separate opportunity as well.
Oliver, Dan Roberts here. It's very interesting when you say that Virgin benefits from kind of the brand equity, even though obviously this part of the business is different from, I would say, the businesses that built that brand equity. I mean, of course, it's still flight in a sense, but then there was Virgin, which a lot of people remember for the mega stores, even if those have largely gone away. But I guess what I'm really asking is if you think that bullishness on this business is in many ways colored by Richard Branson himself, and that kind of the outsized personality there gives a lot of the sheen that a lot of analysts have about this business, or if it really is about the fundamentals. I mean, so many people, when they talk about this business, are really just talking about the exciting celebrity space race between Branson, Musk, and Bezos.
Yeah, I think you bring up a lot of great points, because the luxury travel and the reality of this is about balancing functions, emotions, and aspirations. And Space Forever will have a special place in people's minds and hearts about discovery. So there's a huge part about the brand and the experience. And don't forget, a lot of what happens with luxury goods is it's really the happiness pre and post purchase. So it's a 4-day program, and it's more than just a travel to space. It's joining a membership in a way. So that really changes the game. The Virgin Galactic brand brings very strong household awareness. And also, what really plays in this whole experience is every part of the experience, from the space cabin to the spaceport. And there's a new CEO from Disney. So this experiential component will set Virgin Galactic apart. And also the technology is horizontal. So it's a lot more customary in terms of the actual experience relative to competitors such as Blue Origin, which don't have pilots. Virgin Galactic has 2 pilots. Also, it's 90 minutes in space, and it's a horizontal takeoff and landing.
Hey, Oliver, it's Shauna. I want to go on what you keep bringing up, and that's the word experience and this experiential opportunity that you're seeing Virgin Galactic have. when we think about how consumer behavior is shifting, I'm just curious, what are some of the other areas or some of the names that you see also exceeding based on this thesis, based on this experiential opportunity that you point to as one of the most important factors here going forward?
Yeah, Shauna. So LVMH acquired a high-end hotel chain called Belmond, and that's another. They also own the 21 Club and other properties at Cipriani Hotels. I think that's key to what's happening with the consumer over time, and then retail in general. Retail, the future of retail is really thinking of stores as experience points, as service points, as experiencing the craftsmanship in a flagship. Everything's changing, and I think that as we think about the Uberification of retail at large and retail as a service, this plays into that broader theme. So we're excited about brands that build communities as well, and that includes brands like Peloton and health and wellness. We're excited about LVMH and what they're doing with how experiential is moving away from material and also being a leading platform there. And then we look at a lot of private brands too that are really focused on driving community. I think the future is a lot more about purpose and mission and not necessarily about collecting more stuff.
And then Oliver, very quickly, finally, is that, so does COVID not change this kind of thesis? Does this accelerate this thesis? How are you thinking kind of through what we've seen in just the last couple of months?
Yeah, they've managed through this well. However, it adds complications in terms of the speed and timing, just because of the reality of making sure the workforce is safe. That being said, to be able to afford this kind of ticket, this demographic, it definitely has a high net worth and wants to do this. Also, our surveys really say that customers will pay even more to be earlier in the queue. So the demand is still very, very strong, but safety will be a priority. And there's still FAA certifications up ahead to be had. And the crisis has made them more conservative in terms of timetables.
But of course, as you mentioned, high net worth is really the target here. As we speak, the NASDAQ is at another record high. All right, Oliver Chen, an analyst with Cowen. Again, the firm initiating coverage on Virgin Galactic, outperform rating, $22 price target. Oliver, thanks so much for joining the program.
Thanks for having me.
All right, coming up on the other side of this break, we're going to talk to Dan Dicker about everything going on in the energy market these days. We're back with more on that in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. Well, after crude oil went negative back in April, things got kind of normal in the energy world. We haven't focused too much on crude over the last couple of months, but a man who is never sleeping on the energy markets is Dan Dicker. He's the founder of the Energy Word. He joins us now to discuss what is going on in the energy space. Dan, we had a hurricane late last week, didn't seem to be a big mover for the markets, but crude right now sitting in the mid 40s, kind of where we left it pre-pandemic, if that makes sense. What stands out to you, if anything, in the market right now?
I sit here and I hear you talk about Tesla in one section, and you go on to Virgin Galactic, and I feel so quaint. I feel like such a dinosaur talking about stuff that actually moves economies and makes things work, like oil. Clearly, the entire sector has been entirely left behind. It hasn't participated at all in this stock market rally. It's the one sector, I guess, along with retail, that's representing reality of demand and supply fundamentals. And because of that, it's been pretty lousy to be an energy investor here. One of the few things I could say to people out there is that the only way that you can buy energy equities, which is obviously I still do, is if you don't believe in a 29x forward earnings number for the S&P, and you feel there'll be a reckoning at some point with some of these overrated, overhyped, and enormously high-priced stocks. In which case, almost by default, you'll have some fallback or retrenchment into those blue chips that have been so strong over the course of decades and are not the Johnny-come-latelys like Exxon and Chevron and Schlumberger. But that's about the only positive thing I can say. You have to be positive about energy stocks only if you're negative about the general outlook on the stock market and where it's pricing right now.
Yeah, and I think some people might make the argument that if growth were to surprise, you would see a benefit to some of the cyclical names like in energy, and that market negative could be economy positive. But just to pick up on something you were talking about with respect to the individual companies, of course, today Exxon leaves the Dow, almost unthinkable.
Right.
7 years ago.
I'm ready to cry. It's like the end of the year. I tell you, I feel older all the time. That's like un-American, isn't that? You can't throw Exxon out of the Dow.
I mean,
that's
Dan,
crazy.
It was the biggest company in the world 7 years ago.
For a long time.
And now it's out of the Dow. I guess, does that speak to how much things have changed in the energy sector, or is it really an Exxon specific story in your view?
No, I think it's a sector-wide thing. I mean, you see everybody and his brother just bailing from oil and energy stocks in general, except of course for those alternatives, which are already overhyped. We have a pretty big position in First Solar, which makes sense. But Tesla, again, as a proxy for an alternative energy type play, has been insane. So there is this forward kind of look into alternative energy as opposed to traditional energy. But again, my book, which is coming out very soon, makes very clear that I think that you only build off of alternative energy by leaving that base of traditional energy unhurt and unharmed. And that for that reason alone, I think it continues to have value for many decades to come. That being said, it's got none of the hype, and it's everybody's ignoring it, and it's just a dinosaur sector.
So let's talk a little bit more then kind of about the book and that thesis. Book's called Turning Oil Green. We've seen a lot of announcements. I think there was one a couple months ago from BP about their ambitions. I think they said they want to be carbon neutral, which is crazy because they make oil, they drill for oil. So I don't really know how you become carbon neutral if that's your business. But it would seem that your Royals, BP, Exxons, they have no choice, right, but to try to find a way to say, no, we are actually leading the clean energy revolution. Otherwise, it sounds like there's really no future for them as traditional oil majors.
And there's been a demand from stockholders as well to be more receptive to green energy development. And in the book, I posit that they have to be brought along. In fact, you cannot, move smartly towards a renewable future without having the traditional energy companies on board. They understand the infrastructure. They understand the how to get it, how to move it, how to deliver it to consumers better than anybody else in the world. and to try and restructure an entire energy infrastructure without using what's already there and available with energy companies, I think is insane, especially if you want to move towards a green future as quickly as you possibly can. So in the book, I have a number of suggestions on how to do that. So I won't give it away so someone will buy it besides, my mother. I think that in all ways that traditional energy must play a part in even a completely carbon neutral future, which is what we inevitably will get to.
And then, Dan, quickly before I let you go, we haven't talked all that much during the pandemic. I think one of the most recent times we spoke is when oil had gone to negative $40 a barrel. Just as we look back on that moment, do you have any more clarity on what exactly happened? Does it seem more sensible to you now? Does it scare you, I guess, about the market structure that was able to happen kind of at that moment?
As a postscript, everything we've just discussed, there is this kind of obsolescence that attends the energy sector and the markets that control them, including those future markets. And the one-off that was that negative pricing is clearly a piece of what has been a bankrupted system among energy companies in one place and the energy markets in another place. Again, I talk about this in my book to a certain degree. There is a need to move forward. A lot of these structures have proven in the coronavirus how obsolete and how kind of bankrupt they have been and have been continuing to get. And so I think that again, as an axillary to what we've already been talking about, that's what I take away from that. It was coronavirus put everything into hyperdrive. If there was something that was bad, it became immediately awful. And the energy markets were always sinking towards something that was going to not work out in the end. And those negative prices proved that in a hurry. That's what I think I take away from that, Miles.
All right, Dan, I think this is the most downbeat analysis we've ever had of the future of the energy business.
It goes with the beard. What am I going to tell you?
All right, Dan Dicker is the founder of the Energy Word, author of the forthcoming book, Turning Oil Green. Dan, always great to get your thoughts. We'll talk to you soon.
Thanks, Miles.
All right, coming up on the other side of this break, Jared Blicker will give us a look at the market here. About a half hour to go in today's trading session. Plus, we'll get the latest on what's going on with TikTok. Apparently, that saga might come to an end tomorrow. We'll have the latest here coming up in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. Market losing a little bit of steam here as we head towards the closing bell. Let's go to Jared Blickery for more on this, Jared.
Yeah, we still have the NASDAQ in the green, up about 1%. Let's just take a quick look at the NASDAQ 100 and some of the leading and worst off stocks for the month of August. We'll take a deeper look after the bell, but here's the intraday look. And Apple up 4%, Tesla up 12.5%. We've been talking about that. Here is for the month of August, and you can see these big mega cap stocks doing very well for the most part. Even NVIDIA up 26%. Biggest winner is Tesla. That's up 74% for the month of August, followed by Workday, 32%, NVIDIA, 26%, Zoom, 25%. Lots of big names there. To the downside, BioMarin off 35%, followed by Western Digital and Lam Research. Those two chip stocks off about 10% or more. But here is, I want to take a look at the transports because kind of the underreported story of the month. Lots of gains here. UPS had a record high, FedEx had a record high. The latter, FedEx, up over 30%. Avis Budget Group, that's up over 30%, 33% for the month. Transports have really been on fire. Miles?
All right, Jared Blickery, another month. Tesla goes up 70%. Let's talk on September 30th. I'm sure Tesla will be up another 70% because that is just the way things have gone in 2020. All right, let's turn our attention now to the story that only came up a couple weeks ago, but will never end and seems to have really made no progress towards anything like a resolution. And that is what happens with TikTok's U.S. operations. The latest reports suggest that ByteDance, the company's parent company, has said it will adhere to new restrictions on the export of technology by Chinese companies. And Melody Hom, it would seem that this very much would complicate an already complicated planned or forced divestiture of the TikTok asset to a U.S. business. It sounds like it's going to be Microsoft. This after Triller tried to get involved over the weekend. Where do things stand, I guess, as far as you know, on this deal actually getting done? A deal that to me continues to sound less plausible the more time it goes on.
I think it's anybody's guess, and it's just another wrench, right? Every day, perhaps every half day, there seems to be another development that we sort of have to synthesize here. I do want to point out the latest statement from TikTok, spokesperson saying via the general counsel there, we are studying the new regulations, they're going to follow them stringently, and that seems to be the party line right now. The main sort of big issue that you didn't address directly was over the weekend, we found out that China did increase that list that hasn't been updated since 2008 of export regulations when it comes to technology. And specifically, one that was added was the recommendation of personalized information services based on data analysis. What is the core crown jewel of TikTok? The algo, the personalization algo, the way that they figure out exactly what we want to watch, and somehow we're in a hole for 2.5 hours, speaking from personal experience. So I think TLDR here, to your point, unfortunately, I don't think the TikTok executive team themselves, especially with this CEO departure, has a full, firm grasp on the situation. I do want to point out that I was part of a conversation last week with a lead investor in Triller, and he insinuated that that Triller deal was going to happen. Of course, we know, sure, the paperwork or the request is going to happen, but TikTok kind of responding in kind saying, what's Triller, and brushing off that suggestion. So ultimately, right now, there are too many moving parts on the table to say with any sort of certainty what the outcome may be.
And speaking of TikTok holes, have you made the TikTok pasta yet?
I have made the TikTok pasta. It was fine. Do you love it?
I thought it was pretty good. Honestly, it was significantly better than I thought, considering how many ingredients are in it, which is about 3.
Yeah, Sam Rowe really pushing all of these recipes to us. It's funny because I'm not a huge TikTok culinary gal. Like I'm very much I love the TikTok moms. I love like all of these sort of niche angles. I don't even love the dances, but I digress. This is something that we probably don't have time for right now.
Guys, you have to make the TikTok pasta to fuel yourself and give yourself energy to then record a TikTok dance, obviously. But, you know, one note I'll say about the buyers here, it is funny to me, just quickly, it is funny in the last week how quickly analysts and experts who would come on our live programs have warmed to the idea of Walmart as the buyer and that making sense, isn't it? I mean, you know, when we heard it might be Microsoft, well, that didn't make much sense. Then we heard Oracle, that felt like it made even less sense. Then we heard Walmart, And at first it was like Walmart. And then you see analysts come out and say, well, actually, this makes a lot of sense because it can stoke their retail brand and, it'll also help their advertising. Well, all right, then. I mean, you can talk yourself into any buyer making sense at this point.
Yeah, look, I'm certainly interested in the U.S. assets of TikTok, but I don't have any of the money for it. But I'm definitely interested. Just to go back, Melody, to your point on TikTok subcultures, I'm for some reason I find the Kardashian dubbing subculture interesting. Even though so many of those videos fall kind of flat, I still find them in general broadly funny.
Yeah, I agree with you there. I think the funniest part, though, is Dub Smash, which is the original sort of hub of culture when it comes to lip syncing, when it comes to what musically the core of TikTok was built on. And I'm sure, this is a different discussion, but the kinds of cultural appropriation and a level of this idea of people who typically are white or who typically are not Black tend to appropriate certain kinds of Black culture. It's interesting the levels in which TikTok has been able to avoid some of that criticism, because we know early on with a lot of influencers on TikTok, many of the Black influencers, they were saying they don't get nearly as many as views as the white girls who are copying their dances or who are lip syncing some of the things that Black comedians and artists have said on popular TV shows. So it's really fascinating to see even the sort of bifurcation when it comes to cultural zeitgeist moments, right? Like, how are we actually translating culture via a very simple app right now?
Yeah, I think, again, Taylor Lorenz required reading over the New York Times for all of this, even though it still is kind of inaccessible to some boomers like us trying to figure out exactly where TikTok is at right now. All right, let's switch gears, quickly talk about what's going on in Hollywood this weekend. Mulan is going to make it to theaters. Dan Roberts, you went to a theater this weekend. How was the theater experience?
I went to a theater, and I'll go again, Miles, to see Tenet. Well, first, before my own experience, let me just mention for viewers that Tenet opened up internationally and did $53 million at the box office. Might sound like a small number, but it actually compares to the openings for Dunkirk and for Interstellar based on the number of screens. So it did pretty well. And Tenet is going to open here in the US next weekend in areas where theaters are open. So unfortunately for Warner Brothers and for Christopher Nolan, that doesn't include New York City and doesn't include LA. But in places like Connecticut, where I live, which has done a nice job containing things, a lot of theaters have reopened with distanced indoor movie viewing. And so Tenet will be playing at those theaters. It's also going to open in China, where the movie theater business has bounced back very well. So I think Tenet will end up making a fair bit of money that way. And it's an interesting contrast, a study of contrast with Disney, which is putting Mulan out on Disney Plus for a $30 rental fee. Now, I went to the movies a few days ago here in Connecticut. I saw The Personal History of David Copperfield with Dev Patel, and that is also a Disney movie, by the way. The movie was great. That's neither here nor there for our discussion, but it did the Dickens book justice. It had a terrific, diverse cast. It was funny and fun, but also heartwarming. It was a good movie. But specifically, the theater experience was also fine. My wife and I were the only people in our row. You wear masks. The concessions were open, and the guy serving the popcorn was wearing a mask. Tons of hand sanitizer pumps all around. I mean, there were fewer than 20 people in the screening room. It was lovely. It felt really good to be back at a movie. And, say what you will about your own fears, and everyone has their own level of comfort right now, but we felt comfortable. And if you're someone who loves going to the movies, for us, it felt really good to go back to the movies and support the movie business.
And quickly, I am not yet ready. I'm one of those people to go back to the movie theater. I am curious about the drive-ins, but on Mulan, what's really awesome is this Friday, as it is on Disney Plus for $30, several folks who, mainly Asian Americans, have gotten free access to watch Mulan for free as long as they're participating in a live tweeting conversation to really generate some buzz and some action around it. And I do want to point out there are some really awesome organizations right now, like Gold House, that really helped with the quote unquote gold open of Parasite, Crazy Rich Asians, The Farewell, and Just Mercy, and now with Mulan. So even if you are at home, this kind of chatter and water cooler discussion obviously can still happen. So in some ways, it's almost a blessing that right now is when we can actually be participating and still engaging in entertainment forms, even if it's not in person. So I do want to say I'm very excited about that.
And we're excited for your tweets coming up this weekend on the debut. And of course, we'll talk a bit more about Mulan and what it means for the business coming up in discussions later this week. All right, coming up on the other side of this break, we're going to talk to Larry Adam. He's the CIO over at Raymond James about the state of this recovery, what he makes of the market right now. We're back with that in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York for a bit on where the market stands right now, what to make of this economic recovery. We're joined now by Larry Adam. He's the CIO over at Raymond James. And Larry, last time we spoke, I think you were the first guest we'd had on this program that introduced the idea of the K-shaped recovery. And that's really become, I think, the operating framework, the consensus framework in the last couple of weeks. Where are you on that thesis, and is it kind of playing out as you expected, when we spoke back in June?
No, I agree. It continues to be the best articulation of what's happening underneath the economy, but also what's happening in the equity markets. And if you just think back to what that K represents, if you look at the top of the K, it represents sectors that really weren't impacted by the pandemic and have actually thrived throughout. And then the other part of the upper side of that K is where you see the traditional V-shaped bounce. And if you look at the sectors that we like and the ones that are the best performers of the year, that's where they've been. So that's where technology is, communication services, healthcare, and then consumer discretionary. But I think even intra-sector, you can still see that K unfolding. So let's look at industrials, for example. And if you look at the top of the K, you're going to see that air freight and logistics. But on the bottom part of the K, where you're going to see that delayed recovery, that's where you're seeing airlines. That's where you're seeing aerospace. If you look at the top, home builders continue to do well. At the bottom, REITs not so well. In consumer discretionary, non-luxury doing well. At the bottom, the luxury retailers continue to struggle. So I think that K is a perfect articulation of what's going on. And I think it's going to continue until we get that vaccine that's reliable and broad-based before you can really see those bottom parts of the K really start to thrive again.
Well, and I wanted to ask about, how long you think it can persist, but also, I guess, for how long, because in my view, I guess I would say that the outperformers, whether it's intra-sector, intra-industry, or just within the market, that's been where investors have just kind of focused and they've ignored all the stuff that's lagging. Do you expect that can sustain itself? And I'm sure that clients of yours are kind of wondering the same.
No, absolutely. And I think that it is sustained. I mean, if you look at earnings season, we just came through. Where was the best earnings? It was in those areas that we just mentioned. Where are earnings revisions going higher? It's in those sectors. And if you look at valuations, they're not as expensive as people think because, yes, they have gotten expensive, overall. But the ones that have really gotten the most expensive have been those ones that are lagging. So when you look at industrials and energy, that's where earnings have gone down 50 to 100%. Those are the sectors that have actually gotten more expensive over time here.
And so, we're talking a lot about what's going on in the equity market, but obviously the fixed income market has been very interesting through the summer, where corporates have been able to come to market with, huge issuance. Market's been very receptive to that. We heard from the Fed last week, but in your view, is that going to change at all kind of, how fixed income has really acted over the last couple of months?
Well, first of all, I think fixed income has proven its value, right? It's been a great diversifier. The last time we've had big pullbacks in the market, it's been there to really mute the overall volatility of your portfolio. But I do think that given this record issuance that you're going to see by our government over the next 3 months to 6 months, I think that's going to put some upward pressure on treasuries, for example. So we think yields could move modestly higher to around 1% by the end of this year. But I think this burgeoning economy and the recovery that we're seeing is going to continue to help corporate bonds, particularly the investment grade bonds, where I think spreads can continue to narrow for a while here.
And then tomorrow, September, we are just about 9 weeks away, I think, from the election. Certainly getting questions about that. How are you thinking about changing any of your views here as we head towards that event?
Yeah, we continue to get a lot of questions about it, but I would urge investors not to change your portfolio significantly just based on who's in the White House. Because if you look back historically, it really hasn't played out that well. And if you think about, under President Clinton and President Obama, everybody said you don't want to be in healthcare. And if you look back, healthcare was the second best performer and the third best performing sectors under each of their administrations. Under President Trump, everybody said you want to be in energy because of deregulation and record production. Well, guess what? It's been the worst performing sector by far. So I think it's important to know who's in the White House, but it's far more important to know how the economy is doing. What are the trends underneath the economy? What's the Fed doing? What's earnings growth? Those are more important in determining where you want to invest in this market longer term.
And maybe on the day after his 90th birthday, think about Warren Buffett. Just buy America, and it usually works out fine, kind of on the longest timeline. All right, Larry Adams is the CIO at Raymond James. Larry, great to get your thoughts. Thanks for joining the show.
Thank you very much, Miles.
All right, coming up on the other side of this break, tracking the market here, NASDAQ on close for another record. S&P looking to do the same. We're back with more on that in 2 minutes.
Thanks.